So this is going to play out over time, but it would be a mistake to dismiss this simply as positioning.
Are you describing an environment kind of like 2020, not in terms of just how catastrophic and worrisome it was, but you have this moment in time where the market is trying to find a trend, and it's volatile in the meantime. Is that where we are, just this turning point, and we kind of don't know which way we're going?
So that's a great comparison, because what happened in 2020 had such a major shock that you lost all your anchors. And I think this is where we are today. And I'm really glad we're having Bill Dudley on. Because the question to ask Bill Dudley is, should the Fed regain control of the narrative? You have Jackson Hole coming up. This is a golden opportunity for them. Forget about September. Jackson Hole is much more important to this marketplace, to the well-being of the economy, because the Fed needs to regain control of the economy. Unless you establish anchors, the volatility itself of the marketplace will undermine economic well-being.
But Mohammed, if we're anchorless right now, is Jackson Hole too far away?
I don't think it's too far away. I'd rather have it earlier, but it's not too far away. It's pretty soon, and you can have all sorts of steps by Bank of Japan. You can have verbal intervention. You can buy enough time until then, but you'll need a credible and hopefully effective attempt by the Fed to restore its narrative in this marketplace.
And what do you think that's going to be?
I don't know, because they haven't shared with us some basic information about longer-term trends. We don't know where they see the short-term or the long-term neutral rate. But they better tell us pretty quickly, because otherwise the market is going to take us all over the place.
You've drawn a pretty clear distinction between what you think the market thinks is going on, and by the market I mean well-paid people who are employed to tell us where all of these things are going on and why they're going on, and what you think is happening. What do you think is the ultimate issue at play if it's not the yen carry trade and it's not what's happening at the BOJ? What do you think is the issue at play?
I think the market has recognized that a very high probability of a soft landing was too good or too complacent a view. I think the market has slightly overreacted in its assessment of a recession. I've put it before at 35%. It's still at 35%. The balance of risk is for it to go higher, but it's not a dominant scenario. So I think that fundamentally what you're getting is a reassessment of the left tail. That is what's going on. Now, as that shock went through the world, it exposed vulnerabilities in different places. So you get the classic spillover and then spillback. And that's what we played with. But fundamentally, it is a question of what is the distribution of outcomes look like? How fat is the left tail?
It was amazing to see on Friday, kind of to witness your commentary on where you were versus the market. You were like here, the market was over here. And you sounded offside versus what the consensus was. And all of a sudden this happened, sort of overshot you. Can you just walk us through what you thought about that initially as that was happening?
So start going into Wednesday, where I was saying the Fed should cut, and the majority of people were saying they shouldn't. So I was here, and the market was here. Then you get 2 week prints, and next thing I know, the market goes all the way over here. And all the way over here means they should cut 50 in September. They should cut 75 in September. Oh no, they should do an intermeetings cut. And what we saw is a total collapse in yields. And I said, on X, this is an overreaction. And now what we're getting is the market's coming back to where I think it should. The 2-year back over 4%, that makes sense. It didn't make sense where it went down.
This is not the first time we've seen this though, Mohammed, which is why I bring it up. If you think about last spring, last year, we went from no landing, soft landing, hard landing in the space of about 30, 60 days. We've seen this narrative flipping time and time again. What do you think underpins that? What's behind that?
Well, first of all, this narrative's going all over the place is not a good thing. The US is at the core of the financial system. People outsource their savings to us. We view it as having the most sophisticated, the deepest financial markets. We're supposed to be less volatile. So first, for our standing in the world, and I get lots of phone calls from people outside saying, what is going on? The volatility is supposed to be in the periphery, not in the core. Okay, so why? I think a couple of issues. One is forward policy guidance has become ineffective. I did a simple search on Google. All I put in is Fed policy pivot. And the amount of times that forward guidance has pivoted means that it has lost. Why? Because it's based on excessive data dependence. There isn't a strategic forward-looking element. So you've lost that, and when you lose that, then you rely on the economy for being your anchor. And if anything shocks the economy, then you are anchorless. And there's so much going on in the world that you don't want to be anchorless right now.
Do you think the Fed is at risk of the market telling it what to do? That the bond yields do such a thing that it forces them to do something like an intermediate cut, that it pushes them into doing 50 basis points worth of cuts?
That's the risk, and that's why I put out a piece yesterday saying the Fed shouldn't be bullied into doing what the marketplace wants it to do. Yes, absolutely. That would be a huge mistake if it were to follow what the market wanted it to do yesterday morning.
Who do you think is getting this right? Which central bank is doing the right thing? Been highly critical of a lot of central banks, including the BOJ and the Federal Reserve over the last week, but who's getting this right?
So I think the Bank of England is getting this right. The Bank of England is being the most honest. Last week, when they published that decision, they said 5 people voted for, 4 people voted against. None of this forced consensus where everybody votes for and then the next day they're not even sure what they voted for. And the Bank of England is signaling there are delicate judgment calls here. We may get it wrong, but we will adjust as we go along. And I think the Bank of England benefits from something that the Fed desperately needs: cognitive diversity. Having external members serve on the equivalent of the FOMC is absolutely critical for better decision making.
Why don't they want to do that? Based on experience, they seem reluctant to do so. You called it a false consensus. It certainly feels like a fabricated consensus when you hear all the individual policy speeches and then they get together and say, we're on the same page here. Why are they so reluctant to go forward with that?
I think it's a mixture of insecurity and politics. That's what I ultimately think it is. A much better approach would be for us to know what's the range of views being expressed and how confident were people in the decision that they're taken. And I think the Bank of England conveys this really well. And then it's supported by what the governor says afterwards.
Mohammed, this was great. You're going to be sticking with us through the hour, I'm pleased to say. Mohammed Al-Erin of Queen's College, Cambridge. Equity futures right now on the S&P. Positive here by about 1.2% on the S&P 500. With an update on stories elsewhere this morning, let's get your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. Disney shares turning lower in the pre-market despite the company beating estimates and posting its first ever profit in streaming. Disney also raised its guidance for earnings growth up to 30% from 25%. The film studio snapped a string of losses thanks to the release of Inside Out 2. Streaming posted $47 million in profit, which includes Disney+, Hulu, and ESPN+. Disney announcing it will raise prices for Disney+ by as much as 25%. After that massive CrowdStrike outage last month, 2 corporate giants are playing the blame game. Microsoft now saying Delta Airlines turned down repeated offers for assistance, echoing claims made by CrowdStrike. According to a letter Tuesday from Microsoft's attorneys to Delta, the tech giant reached out to the airline to offer technical support every day since the outage happened on July 19th through July 23rd. And each time it says Delta turned down the offers to help. The letter also says Microsoft CEO Satya Nadella also emailed Delta CEO Ed Bastian and never heard back. And this one is from Mr. Elarian. Taylor Swift is the top nominee for MTV's 2024 Video Music Awards. Swift has 10 nods, largely thanks to her Fortnite video, which also features Post Malone, who's nominated for 9 awards. The only other artists within striking distance are Ariana Grande, Eminem, and Sabrina Carpenter, who each have 6 nods. Swift will have more history to make at the ceremony when she goes for a 3-peat in Video of the Year. That's your Bloomberg brief, John.
Hara, thank you. You're so popular now. Look at you, at the leading edge of sort of what's popular in America and worldwide. How does that feel?
So after people discovered I had gone to the concert, in meetings I would hear people say, we need to tailor our response swiftly.
Nice.
Because you're a Swiftie now.
Nice, I like that. Mohammed trying to go sort of like camouflaged in a pink T-shirt. You know, did you think people would miss you? Wouldn't identify who that was in the stand?
I do what my wife tells me to do.
That's the right thing to do, Mohammed. Well done. Up next, battling for swing state votes.
Tim Walz's record is a joke. He's been one of the most far-left radicals in the entire United States government at any level.
J.D. Vance literally wrote the foreword for the architect of the Project 2025 agenda. I can't wait to debate the guy.
We can't wait to see a debate, if we actually get a debate. That conversation up next, live from New York City. Good morning.
covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Getting abused for saying that yellow cabs for public transport. TK told me this when I first moved to New York City.
That's your first problem.
TK said yellow cabs for public transport.
For
So
someone
I tried to be a man of the people and hail yellow cabs.
would you call Tom Keene a man of the people?
Absolutely. That's who I look up to. Equities right now in the S&P, up by 1.2%. Under surveillance this morning, battling for swing state votes.
Tim Walz's record is a joke. He's been one of the most far-left radicals in the entire United States government at any level. But I think that what Tim Walz's selection says is that Kamala Harris has bent the knee to the far left of her party, which is what she always does.
J.D. Vance literally wrote the foreword for the architect of the Project 2025 agenda. I can't wait to debate the guy. That is, if he's willing to get off the couch and show up. So.
We'll leave that joke there. Here's the latest. Vice President Harris and Governor Walz holding rallies in Wisconsin and Michigan today as part of their swing state tour. Senator J.D. Vance said to make stops in the same string of battleground states, with Trump's next rally scheduled on Friday in Montana. Bloomberg's Josh Wingrove joined us now for more. Josh, the race is set. Walk us through the next month or so, the key dates for you and the team.
Thank you for leaving the couch stuff where it is, John. I appreciate that. This next week is going to be just a sort of blitz of all those 7 battlegrounds that Kamala Harris wants to visit with Tim Walz. I think one thing to understand here is, like, her map is a lot different. Biden had a pretty clear path through the northern battlegrounds. Harris, it's just not so clear. And so either this is sort of a rising tide lifts all boats, where suddenly she'll find herself competitive in all 7, or she needs to find different paths. And it's just not clear where it's going to be. Though last night was the first one in Philadelphia. I was there. Governor Shapiro, who of course was a finalist but was passed over for Governor Walz to be the running mate, was there, gave a pretty rousing speech to introduce her. No sour grapes factor, but found the need to say that he's proud of his faith. And that just gives you a hint of some of the wrangling that's happened in the Democratic Party leading up to her selection yesterday, with questions whether Shapiro, being Jewish, would make him vulnerable to attacks, that he was too pro-Israel or whatnot. So this has been a fraught one, but the reaction we saw yesterday from across the Democratic coalition, from AOC to Joe Manchin, supporting Tim Walz, I think made him the sort of do no harm pick, and that seems what Kamala Harris is looking like. So we'll get that 1-week tour. Whether Joe Biden hits the campaign trail remains an open question. There's some reporting that they're kicking tires on that. But of course, all this is heading up to that convention later this month in Chicago, which will really be a coronation. This momentum, you'd expect, will continue to carry Harris in the polls. But right now, it's looking like a coin flip race, John.
So, Josh, what we have right now is kind of these big moments for her. Rallies, she's going to be at the DNC, this coronation you speak about. She's going to be on teleprompter. 2 questions. When is she sitting down for an interview so we kind of understand her policy and how she differentiates herself from Biden? And will there be a debate?
Those are great questions. She's not sat down, as you know, for a wide-ranging interview since becoming the nominee. She gaggles occasionally, which is to say bats around a couple of questions under the wing of the airplane. They haven't said, they haven't got there, and they're not going to be able to keep her sort of hidden away as part of it, or in these sort of forward speeches that don't have any question and answer, or at least I don't think they'll be able to do that. So we'll see where it goes. Certainly, J.D. Vance in particular is getting out there doing a lot more press stuff. I think we'll see that with Tim Walz as well. As for the debate, Right now, they're in a standoff. I should say Harris and Trump are in a standoff. Trump is doing that early September 4th, if memory serves, Fox debate that he unilaterally sort of ginned up and said, Harris got to meet me there or nothing. Harris laughed that off, said, forget about it. I'm going to the September 10th ABC debate, the one that Biden and Trump and potentially RFK had agreed to, ages ago. Trump says he now won't do that, sort of this fig leaf of saying he agreed to it with Biden, which isn't really true, but was during the era of Biden. So this back and forth, these silly games. It looks like right now Trump doesn't want to debate Harris, and Harris doesn't want to go to Fox. So if Trump is digging in and saying Fox or nothing, doesn't look like we'll have a debate, at least for now. The vice presidents, on the other hand, are another story. Both Vance and Walz are chomping at the bit to debate each other, I suspect, unless one of their top-of-the-ticket colleagues says no, that those two will be unleashed against each other at least once. They seem to be, happy for it. Republicans are almost as delighted with the pick of Governor Walz as Democrats. They think that they can go after him on certain issues. It's not just because they thought that Governor Shapiro would, almost take Pennsylvania out of play. They definitely were worried about Shapiro being the pick, but Governor Walz, they see some paths to sort of drive a wedge between Democrats and swing voters.
How do you see that shaping up, Josh? As Anne-Marie mentioned earlier in the show, 70% of the electorate just don't know who he is or what he's about. How does that look like, the race to define Walz?
I think the compressed timeline for Harris is probably helping her a little bit, right? Harris is not someone who's played error-free ball for 3.5 years. She kind of gives wonky speeches sometimes, but she's played pretty error-free ball in the last couple of weeks, and so this could help. And the same with Walz, if they can get him out there, as they're going to do in the next 7 days, they will try to define him before Republicans can define him. In Congress, he had a very down-the-middle voting record. As governor, he's been more progressive. Progressives backed him as these sweepstakes were carrying out, in part because he was just sort of the most progressive option of a list of folks that weren't all that progressive. To say that he's like a far-left radical, I don't think that will necessarily hold all that much water, but he is admired by progressives, so we'll see where that goes. But last night I was there in Philadelphia. With all due respect to President Biden, the energy levels are they're just not comparable. I mean, Democrats are just in a much different place where they are. There were thousands of people there. They were jazzed. This is just totally different than 3 weeks ago.
Josh, appreciate the update. Thank you, sir. Josh Wingrove there of Bloomberg down in D.C. on the campaign rally of yesterday evening. This pick provides a lot of ammunition to the Republicans, and there's an opportunity to define Harris's running mate. If they take it, let's see if they're disciplined enough to do so. There's
a huge opportunity because, as we've seen in the polling, more than 70% of Americans don't know who he is. I mean, did most Democrats know who he was until he was all of a sudden appearing on cable news and in a short list? There's a lot of ammunition because, to Josh's point, when he was 12 years in Congress, he was a moderate. He voted for tax cuts under George W. Bush, but he's not so as a governor. He is definitely to the left.
Yeah. Coming up on this program, we'll catch up with the Disney CFO, Hugh Johnston, as the company turns a profit in streaming, but faces some headwinds in the theme park. We'll continue that conversation up next.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Equity futures on the S&P 500 positive here by a 1.2%. There's a lift, a rally in the Nasdaq once again up by 1.4, and a Russell up by 1.8. Just sort of unwinding the moves we've seen over the last couple of days. It's amazing to see in the bond market. Think about where we were on Monday morning. The 2-year was at 365 at about 8:30 Eastern time on Monday, all the way back to north of 4% at 4.02%. And just to complete the round trip, dollar yen. Big move higher off the back of some BOJ verbal intervention. 147.25. We've got Mohammed Al-Erin with us for the hour. Mohammed, I've got to ask you, do you think this is over? Have we put this behind us? Was this just sort of a one-off market freak out that we move on from?
I don't think it's over. I think what's over was the overreaction, but there is still a question as to where do markets settle long term.
Got to work out where the Federal Reserve settles long term as well. What's the destination for interest rates at the FOMC? Under surveillance this morning, here's the latest. Goldman Sachs CEO David Solomon saying the Fed will forego an emergency rate cut. In an interview for an upcoming episode of the David Rubenstein Show, Peer-to-Peer Conversations, he added that he expects more volatility ahead, but he does not see a recession. You can catch the full interview on August 14th. Danny, I've got to say, you know, the emergency rate cut stuff seemed pretty wild on Friday, seemed pretty wild on Monday. Have we backed off from that now?
It feels like we have to a remarkable amount. I mean, not only has the dialogue backed off of it, but the market has backed off of it too. It still doesn't answer this question though, and Solomon clearly comes down on the side of there's not going to be a recession, but it's just slowing. Are we slowing to normalization, or is it going into recession? It literally feels like this is like Schrodinger's economy, where you don't know whether it's alive or dead, and you have to look inside the box to find out, and we have yet to actually see inside the box. So with every piece of data that comes in, we're just kind of assuming what it is.
Well, how quickly could the pendulum swing? And to Mohammed's point, the market is so data dependent because the Fed told them to be. Also, what Solomon said was about the jobs report. He says it wasn't horrible. It just was softer than people were expecting. That's why the data next week is so important.
Data dependent or data point dependent? Mohammed, you've made the point repeatedly. There is a difference.
There is a difference, and you have to combine with forward-looking. I think it is incredible that now we're all going to focus on jobless claims, one of the noisiest series out there, but depending on whether we get well above 250 or well below 250, this market is going to react on Thursday.
Citi's Andrew Honhor said that the danger zone for jobless claims was about 260. We're not too far away from the 260 number. Elsewhere in politics, a new poll from NPR, PBS News and Maris finding Kamala Harris leading Donald Trump 51% to 48. It was conducted from August 1 to August 4. So in the last week or so, the previous poll from July, Anne-Marie, showing Trump leading Harris 46 to 45. This has been a very, very close race, and it gets a whole lot closer.
Well, to Josh's point, you saw the enthusiasm there yesterday. Biden was not drawing those crowds or that kind of enthusiasm. So Kamala Harris was able to tighten the race. This poll, though, was done before she had her VP pick. And I actually found the numbers about him more interesting. More than 70% of Americans don't know who this person is. There is going to be a race to define him because she has not come out and sat for policy interviews. How much does she differentiate herself from Biden? And who did she pick to expand her base or potentially just bring out the base? There's going to be a lot of concern or excitement about Governor Walz?
Hopefully we see some actual policy interviews, because it's been amazing how few we have actually seen, which is like none at all, absolutely zero policy questions, which is kind of nuts.
And I don't consider a gaggle under the wing of an airplane an interview.
No.
You can walk up, say what you want to say, I've been to them, and then you can walk away.
And it would be entirely inappropriate to ask anything about policy, given the nature of that situation anyway. We were literally on the tarmac off the back of a hostage swap. So like, a prisoner swap. So what are you going to do? Start asking questions about the economy and Joe Biden dropping out of the race?
And then you look incredibly tone deaf as a journalist.
Precisely. So there we go. We want some questions, and some answers too. Let's turn to the earnings. Disney delivering better than expected earnings. The company's streaming business posting a first ever profit alongside a sluggish performance from its theme parks. The stock is down by about 1/3%. To weigh in on all of this, I'm pleased to say that we can catch up with the Disney CFO, Hugh Johnston. Hugh, it's wonderful to catch up with you, sir. As always, we've got to start with the price increases, first of all. It's on the minds of a lot of people, I can tell you, around this table as well, Hugh, so let's get into it. We've heard from a lot of companies that have talked about a loss of pricing power and sliding sales. What have you seen in the streaming business that gives you confidence that you can hike prices without that delivering increased churn?
Great. Well, good morning. Great to be with you all. Obviously, terrific quarter for us, and you all have mentioned the numbers a few times. The entertainment business is doing exceptionally well right now. We had the top movie in May, June, and July in the form of Planet of the Apes, Inside Out 2, and then now Deadpool. That's real value to the consumer. And as we think forward to what's going to be appearing on the streaming service, those 3 great motion pictures, the IP that we've produced ourselves, are going to be on the streaming service, as well as an enormous number of Emmy-nominated TV shows, including Abbott Elementary and The Bear, Only Murders in the Building, and of course Shogun, the huge hit. And when you deliver that much value to consumers, consumers are willing to pay a little bit more, because frankly, they're getting so much back in terms of entertainment.
Hugh, I've got to say, I'm with you. Shogun was awesome. I said that last time, just to endorse it once again. One of my favorites of the last 12 months. Clearly, the streaming business is doing well, which opens the door to hike prices. You can't say the same thing about the theme park business. Just what is going on there, Hugh?
Yeah, so one of the things to keep in mind is the theme parks business we have actually grew in the quarter. Revenue was up 2%. So we're not talking about a business that's going negative in terms of growth. Earnings were down a little bit because we had inflation and we're making some investments back in the business. What we see happening more than anything is the lower income consumers are a little bit stressed and shaving a little bit off of their time at the park. And then higher income consumers are tending to travel overseas a little bit more right now. But given the strength of the IP that we have in the park, given the quality of the experience, when the consumer is soft, it tends to hit us late. It hits us a little bit less, and we tend to recover early. So we really just see this as a few quarters of slight perturbation in the numbers. Frankly, I think we're going to be right back as we get into the middle of next year.
Hugh, one of the other complaints you commonly hear with the consumer is about bundles. Not that they're not good, but that there's just too many of them, and it's giving people fatigue. Do you think there needs to be some consolidation? Do you agree that there's just too many options right now?
Well, consumers do seem to appreciate having a limited number of bundles. Now, what we've tried to do with our own offering is offer the individual pieces, or if people want to get a discount by bundling, we're happy to do that. So that said, I think you do see a trend where there's probably going to be a few big competitors in the marketplace in streaming, as we see right now between Netflix, Amazon, and ourselves. And then there'll be some smaller competitors out there, and they'll have to decide how they're gonna run their businesses.
Well, another huge draw of some of these is sports rights. And on this, Hugh, the NBA has had this very odd bidding war where you've come out unscathed, but Warner Bros. Loses out. You have Amazon.com, a new entrance in there. You have all these streamers coming in, trying to get their hands on live sports events. Do you think this is a healthy or unhealthy development for the industry?
You know, generally speaking, what you see is sort of the leagues are choosing to go with the big winners in all of this. So they've obviously been with us. ESPN in the third quarter had 49% market share of sports viewing, which is obviously a terrific number. So we have the A package with the NBA. We'll have the NBA Finals for the next 12 years. Beyond that, I'd be speculating as to get into what their decision-making process was. But I think in general, they're quite pleased with what we've been able to do for them. And obviously, we're happy with what they've been able to do for us. And you combine our NBA rights along with college football, along with the NFL, we've locked up sort of the most important sports to us in terms of being big and quite popular for an extended period of time. So we feel good about where we sit.
Hugh, I know there's a different price point, whether or not you want to be an individual that has to sit through advertisements. Are you seeing an uptick of political ads given the season we're in?
No, we really haven't seen much in that regard. So I can't certainly say that.
So you don't, do you expect that to happen? I mean, everyone says after Labor Day, this is when the campaigns are going to be in high gear up until November. Are you expecting an uptick of political ads on any of your streaming services?
Yeah, it's a great question. I couldn't tell you the answer to that one. So what I can tell you more broadly is the advertising market right now is incredibly healthy. We grew advertising as a company 8% in the quarter. Our upfronts for next year were quite successful. The upfronts were up 5%. And in addition to that, the streaming service saw a 20% increase in advertising, and ESPN saw a 17% increase. So generally speaking, the ad market is healthy. The biggest places that it's healthy are consumer and then technology.
Are you concerned that consumers right now potentially are going to shrug off the price increases? Because what we hear from a lot of companies is that we do see consumers trading down. Why do you think they're willing to pay for a higher price point?
Well, I think the biggest reason is it's always important to focus on this. The consumer receives value, and what they pay is price. And because we're delivering so much value, I mean, really an enormous amount of value in terms of the hits that I just mentioned, but then in addition to that, the combination of Disney Plus, Hulu, and then we're going to have an ESPN tile and ultimately ESPN flagship on our streaming service, that's a huge amount of value for consumers. And as they're allocating their entertainment dollars, I think they're going to view us as a great place to put them.
Hugh, you mentioned Hulu. Just how close are we to an agreement with Comcast? Where are we?
Yeah, we're in the middle of an arbitration right now, and as always, I'm not going to comment on arbitration outcomes and all of that. My guess is it's going to take a little while, but ultimately we'll get to a good place for the Walt Disney Company.
Got a decent idea of what the time frame is, Hugh, what a little while is?
Yeah, you're probably talking a matter of a few quarters would be my guess, but that's just a guess, so take it as that.
Well, just a guess as well on the theme parks as well. I just want to nail you down on that too. You talked about the middle of next year for the theme park business to be sort of bouncing back to where it was. The guidance has sort of shifted out, Hugh. What's the firm guidance coming from the company now? Because I remember it was going close to year end, we'd get that bounce. What happened?
Yeah, the consumer came in a little bit softer, and it was really the consumers that I mentioned earlier. The lower-income consumer is choosing to spend a little bit less, and again, the higher-income consumer is doing more overseas and outside the U.S. But again, I'll remind you, we're still growing in that business, so it's not a question of the business has gotten way off track. It's just a little bit softer than it was before because we're seeing it toward the end of the quarter. We saw a few consumer trends.
You have quite a unique vantage point, of course, Hugh. I used to talk to you when you were over at Pepsi during the pandemic. Coming out of the pandemic, you're now with Disney. So you have a very, very unique view of where the consumer is. What gives you the confidence just looking at your dashboard that it bounces back, that it comes back? Where does that come from?
More than anything, I do believe there's resilience in the U.S. economy. Obviously, market.
Appreciate your time, as always, sir. Hugh Johnston there, the Disney. Repeatedly, listen to the companies. Let's listen to the company. He thinks, Hugh Johnston over at Disney, thinks that this consumer is going to bounce back. It's okay that this labor market is perhaps better. This economy is better than some people say it is. Where are you at?
So I heard him say two things. I heard him say that the weakness right now is because low-income consumers are spending less and high-income consumers are doing something different. And then I heard him say, and I wrote it down, but don't worry, Disney parks will be right back. What I didn't hear from him is, will they be right back because the high-income consumers are going to be coming back, or is it because the low-income consumers will recover? And I think that for me is still ambiguous.
What would you have more confidence in?
I would have more confidence if he's right, it's because the high-income consumers decided to spend less on experiences, and rather than fly overseas, as you mentioned, they're staying at home.
Fewer trips to Italy and more trips to Florida.
Is that what you're going to be doing?
Is this about me? I'm just talking about the general public.
Well, we've already established that you don't take
about me. I don't know if I'm a Disneyland kind of guy. Do you think I'm a Disneyland kind of guy?
You're not. That's what you're not a public transportation type of guy.
I'm the bellwether for any of this.
Maybe Disney in Paris.
Disney? No, we went there. The Ferro family went there. Went there a long time ago. I can share that in the commercial break. It would be unfair to Disney for me to share it on air. They didn't go so well, let's put it that way. But that's about us. That's not about them. All right, that's just about us. Are we done winding me up? Good. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackett. Say, Yahara.
Hi, John. Vice President Kamala Harris and her running mate, Governor Tim Walz, held their first rally in Philadelphia last night. Harris introduced Walz on stage, hailing him as a fighter for the middle class. The campaign saying they raised more than $20 million since the Walz announcement yesterday morning, which they hailed as one of their biggest fundraising days. Harris entered August with a larger war chest than Trump, reversing a difficult fundraising stretch for Democrats. Shares of Airbnb are plunging in the pre-market nearly 15%. The company gave a disappointing outlook for a third consecutive quarter, setting it up for the slowest pace of growth since 2020. It also warned of slowing demand from U.S. vacationers. One area that saw positive results was bookings for larger parties after the company retooled its marketing toward groups choosing multi-bedroom homes over hotel rooms. And Boeing is redesigning its 737 MAX door plug. That's the one that blew out of a plane mid-flight in January. This coming as part of an overhaul after that accident threw the plane maker into crisis. The company revealing the plan during a day-long hearing with the U.S. National Transportation Safety Board, which grilled executives from Boeing and supplier Spirit Aerosystems about their safety and manufacturing culture. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, the Fed remaining patient.
There's a little more room for confidence. Confidence that we're slowing but not falling off a cliff.
The longer we were restrictive, we're going to have to start thinking about the employment side of the mandate.
That conversation up next with the former New York Fed President, Bill Dudley.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Stocks on the S&P positive here by a little more than 1 full percentage point. In the bond market, yields drifting higher by 4 basis points to 10-year 3.93. Under surveillance this morning, the Fed remaining patient.
We're headed back down toward normal. The question is,
of course, are we normalizing or are we weakening? Those are two very different things.
Underneath the hood of the labor market report, there's a little more room for confidence. Confidence that we're slowing but not falling off a cliff.
You know that I believe that we are restrictive. The longer we were restrictive, we're going to have to start thinking about the employment side of the mandate.
So here's the latest. Fed officials refusing to overreact to last week's payrolls data. Former New York Fed President Bill Dudley suggesting that patience might be misplaced. Writing this, the Fed's wild ride has only just begun. A deteriorating labor market tends to be self-reinforcing. The longer the Fed waits, the greater the potential for damage. An immediate rate cut is in order, but that's very unlikely. Prepare for more volatility in stock and bond markets. Bill joins us now for more. Bill, let's start with the labor market, then we can get to the Fed's lack of response to it. What suggests to you that this is self-reinforcing? This is the beginning of something much worse?
Well, a couple things. Number one, we've seen a rise in unemployment claims. We've seen a drop in the hires rate. We've seen a drop in the quits rate. It looks to me like the labor market is cooling off quite significantly. We've also triggered the so-called sound roll, where if the unemployment rate rises by more than 0.5% over a 12-month period, every time that's happened, we've ended up in recession. So there's a lot of risk out there to the downside in terms of the labor market. On the other side of the mandate, the inflation news has been very, very good recently. So it seems to me that the Fed needs to hold both sides of the mandate with equal weight right now, and that implies that monetary policy should be neutral, not restrictive. And we're a long way from neutral. I mean, people don't know exactly what a neutral monetary policy is precisely, but nobody thinks that 5.25% to 5.5% federal funds rate is consistent with neutral. Probably somewhere in the 3 to 4% range is where the Fed should be.
Bill, you've had an enormous influence on how people are thinking on Wall Street about what's ahead. So I want to ask you, if you think an immediate rate cut is not on the table, that they won't move into meeting, what would you recommend they should do in the next few weeks?
I think what they should do is change the messaging a little bit and make it very clear that they're now focused more on the labor side of the mandate, get the market attuned to the notion that if we get weak data over the next 6 weeks, that 50 basis points is highly likely at the September meeting. You can put 50 basis points firmly on the table if the data flow continue in the same direction.
And do you think they'd be willing to do that? This has been a very backward-looking Fed, and now they need to regain control of the narrative. Do you think that that by itself, at Jackson Hole, for example, would be enough to regain control of the narrative?
Well, it'll help a lot, because if people feel that the Fed's got it, financial conditions will become more accommodative, the stock market will recover, and they'll provide support. The problem here is when the labor market starts to deteriorate, confidence starts to decline. We saw that over the last couple of days. The big change in market sentiment. And when market sentiment deteriorates, that can be self-reinforcing. People start to pull back on hiring. People pull back on spending. Next thing you know, the unemployment rate hasn't gone up 0.5%. It's gone up a full percentage point or two percentage point. You're in a recession. Now, the good news here is that if we have economic weakness, the Fed has plenty of firepower. They're a long way from 0% short-term rates. So the Fed can respond pretty aggressively if needed. And I think my view is that the risk that they're going to need to respond aggressively has increased significantly in recent weeks.
Bill, I just want to put a fine point on that, because you did write about 2 weeks ago, before the Fed decision, before we got the jobs data, that not going in July would increase the risk of a recession. And all of that happened. So just how acute is the risk at this moment?
Well, I think that what's happened is there's quite a bit of stress in a couple areas of the economy. Number one, low-income households are really feeling it, both because they're tapped out the savings that was generated by the fiscal transfers during the pandemic, and two, they're the ones who pay the higher short-term interest rates in terms of credit card debt and auto loan debt. And number two, we're seeing softness in the housing sector, especially in multifamily construction. So you're seeing areas of weakness that are leading to softer labor market, and that's the softer labor market, though, is the key thing. If it frightens consumers, then you have weakness in consumption, and the thing becomes self-reinforcing.
I think the confusing thing for a lot of people, Bill, is for every weak point, there seems to be a strong point. For every issue at Airbnb, there is a Disney that can raise prices. There is an Uber that people are willing to buy. How do you distinguish between a lower-end consumer that's dropping off a cliff and one that has just gotten more picky with where it spends its money?
Well, it is difficult to sort out, and high-income consumers are doing pretty well. I mean, they've locked in low mortgage rates. They have been the beneficiaries of a very strong stock market. Even after the recent decline, the stock market is still up quite, over 10% this year. So the high-end consumer is feeling pretty good about things, but the low end is not. The other thing, of course, is also what's happening on the investment side. The Biden administration had a number of initiatives that boosted investment spending: infrastructure, CHIPS Act, climate. And the question is, what's the impetus from investment from those programs? Has that peaked or not? And if that has peaked, that's another source of potential restraint in coming months.
Bill, it was great to catch up with you, sir. As always, appreciate the comments this morning. Bill Dudley there, the former New York Fed president. Mohammed, just want to get some final thoughts from you. How offside do you think we are on rates when we've spent the last 2 years debating whether we're sufficiently restrictive?
Well, if you just listen to what Bill said, and I listened very carefully to what he said about the labor market, if he's right, we're quite offside. We are way too restrictive.
Like 100 basis points offside?
Yeah, I think the more interesting debate is where's the destination? And I think there's major differences of views here as to what is ultimately the destination. Is it in the 4s or is it below 3?
Well, the market at the moment is certainly focused on the path. You're focused on this. I've just seen the piece that's just dropped. Mohammed's just published in Bloomberg Opinion. How do you do that at the same time as this? Waiting in vain for a Volcker moment. You say the system needs a Volcker moment. What is that Volcker moment?
Well, every time central banks blink, the Bank of Japan blinked this morning, the markets take it further. So it makes the next episode even more difficult. I think a Volcker moment is having the courage, as Paul Volcker had in the 1980s, to say, I'm going to break a certain mindset once and for all. And he broke the inflationary mindset once and for all. But no one right now wants to be the source of that Volcker moment.
Do we need to see something a lot worse, something like Monday, but even more to shake the Fed from that, to get them to do what you're talking about?
Yeah, I think I do, but you also need someone who is confident enough to be able to say, I'll see it through. And that's what we haven't had so far.
So you don't sound like you think that they will change to get where they should be.
No, I don't. I think we're going to continue playing this repeated game until something bad happens. But this repeated game can be played for a while.
Does he need to communicate the destination at Jackson Hole?
He absolutely needs to.
How does he do that? What does that look like? What does it sound like?
He'll say, we've looked at this. This is what our instincts are right now for where we're going. We're going to be going down that path, but we will course correct as we get more information. But you need desperately to anchor this market, John.
Mohammed, appreciate it. Just fantastic. You've nailed the turn in this economy twice now. Just absolutely brilliant. Mohammed Al-Ain with Queen's College, Cambridge, on the latest in the US economy and over at the Federal Reserve. And the third hour of Bloomberg Surveillance, the lineup looks like this. Alicia Levine of BNY Wealth, Pierre Farragut of New Street Research, Ian Lingen of BMO, and Ashok Bhatia of Neuberger Berman. The third hour of Bloomberg Surveillance just around the corner, with equity futures on the S&P up by a little more than 1 full percentage point. In the bond market, yields are higher by 3 basis points on a 2-year, up 4 basis points on a 10-year. Your yield this morning at about 393. And if you'd like to know where dollar yen is, the yen is a whole lot weaker. Dollar yen up by 2%, 147.21.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working. Then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of success. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
This move in the market has a lot more to do with positioning, over leverage in some cases, volatility, than it does the economic fundamentals.
When the sentiment shifts, when the trends change, that always causes a lot of turbulence.
We've obviously had a level shift in the volatility environment across markets.
Momentum had been probably the best factor all year. I think we're going to really get exposed as that passive has now become somewhat of a momentum strategy.
When we put into context where we are, I think there's a lot more panic in the market than is warranted.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Every morning at the moment starts with dollar yen, so let's start with dollar yen. Dollar yen right now at 147. It's a move of 1.9%, so that's a weaker Japanese yen, and that move is engineered by some comments from the BOJ's deputy governor. A bit of verbal intervention, a blinking contest between the market and the BOJ, and the BOJ's lost, and lost quite quickly, Danny.
They certainly have, but for now, it is a market that is rallying, potentially out of its hand. I mean, it's kind of insane to see comments from a deputy governor and then to see the Nikkei basically erase all of its losses, which were the biggest since 1987. Something's not adding up, and a lot of people have said it's just positioning. But if you have a deputy governor who says we still have a tightening bias, I don't know. Is it just positioning?
The Nikkei have been absolutely ridiculous. Just in a word, ridiculous. To see the biggest one-day loss since 87, followed by the biggest one-day rally since, when was it, 2008?
Yeah.
And then I guess this is stability at the close today. The Nikkei 225 is up by 1.2%. Have we just encouraged a group of investors just to pile on the old trade once again?
I just don't understand if you're in this market and you see pain to that extent, and then you're like, well, it came back, so I don't mind. I can keep buying it. The deputy governor said something, so I can get back in it. I mean, surely you look at the volatility, and even just holding this thing in your portfolio, all of your returns are going to look out of whack. Your volatility is going to look out of whack. It's not performing as it should.
But is the Bank of Japan basically just putting out the red carpet for people to come back into the market? Were they bullied into this? Mohamed El-Arian, even though he was on with us the last hour, also managed to get out this piece. And he says this signal, which he suspects was partly in response to external nervousness about global stock losses, was seen pro-risk by markets. So they're nervous, but the markets are saying, well, you know what? Now we're ready to go for more.
Yen selling, reloaded, dollar yen at about 147, 146.98. There's a single name out there we need to talk about. I've said repeatedly, we're light on The data, don't get much of it. Jobless claims tomorrow morning. Light on the Fed speak. Only heard from a few so far, the likes of Goolsbee, Barkin, and Mary Daly. Light on earnings too, but we do have Disney. So let's talk about Disney. Disney in the pre-market, just about unchanged in early trading. What we've heard from the company so far is that the streaming business is doing well, which means we can hike prices. The theme park business doing less well. And guess what the culprit is for this? Lower income consumer spending. They're pulling back at the parks. And the higher income, they're traveling abroad but not going to Disney. So we've got to work out where this bounce comes from. Does it come from the higher income spenders coming back or the lower income spenders bouncing back? Which one is it?
I mean, take your pick of what every company has said to try to figure this out. Uber in their earnings yesterday, the CEO said, while our consumer tends to be higher income, we're not seeing any softness or trading down across any income cohort. So we've got to wrap our heads around this. Is this a lower end consumer that is really struggling? Or is it simply a lower end consumer that is being more picky, that there is some price fatigue and they're not willing to, you know, go pay up for theme parks. They're not willing to go pay for McDonald's, but they are spending a lot at Taco Bell, for example. We had Yum earnings yesterday, which were extremely strong.
But it's also the higher end consumer that is at this moment, at least according to the CFO was saying, that these people are jetting off to Europe. It's Amalfi Coast versus Orlando. They are not here. And what the CFO, though, said is maybe next year we'll start to see that demand come back. But I think this is more of an understanding, this bifurcation we are seeing within the consumer.
Seen it repeatedly again and again and again, and see it again this morning. Disney just about unchanged. The broader market is positive by 1 full percentage point on the S&P 500. Equities with a little bit of a bounce in the bond market. Treasuries lower, yields are higher. Just a little bit of softness coming back into the Treasury market. We're up by 3 basis points on a 10-year, 392.78. Coming up this hour, we'll catch up with Alicia Levine of BNY, and while we're still on course for a soft landing, Pierre Ferragu of New Street on why he is upgrading NVIDIA, and Ian Lincoln of BMO on the odds of a 50 basis point cut from the Federal Reserve. We begin with the big issue. US futures adding to Tuesday's gains going into the opening bout. Dovish comments from the BOJ lifting sentiment this morning. Alicia Levine of BNY Wealth is not expecting a recession. We still believe the macro data are pointing to a soft landing, but the areas of concern are growing, to include softness in the labor market. Alicia joins us now for more. Alicia, good morning.
Good morning.
Let's get into that. Where does that more constructive view come from on the economy?
Because the data are really still quite good, and even the forward-looking data are good. And let's look at what's going on in the credit markets. The spreads are really holding in there and are not blowing out. And that's really the first view of what's happening with corporates. So spreads are fine, and the data just macro are fine. The ISM services data really came and saved the market. You know, on Monday when it came in better than expected, and the employment data for services came in better than expected. That was a big number. So I think you're going to get revisions on non-farm payrolls in the next month, and it just doesn't seem that we're moving towards recession. Now, having said that, I think the Fed is too tight here for where inflation is going, and real rates are quite high. So it's time, gentlemen. It's time. You know, it's time to start the cutting cycle. But we don't see evidence of a recession yet, and the soft landing is still in play here.
How offside do you think this Federal Reserve is? It was a question we explored in the last hour. How offside do you think they are?
So I think they could cut 100 basis points here, and they'd still be tight.
Still tight after 100?
Well, because you want a real rate, and we're 2.5% on PCE, so that seems to make sense, right?
So if they are still too tight, even if they cut 100 basis points, but the economy looks okay, at what point does that cease to be the case, that they continue to be too far behind and they don't catch up?
So it's a great question. I think let's talk about the institution for a second. As an institution, the Fed is set up to be a little bit late because they're looking at data. You know, the statements are written 2 weeks before the meeting, and even as data may come in those 2 weeks, those statements don't get revised, and the press conference is the press conference, even if you get different CPI that morning, and we've seen that in the last few Fed meetings. So I'll say I think they know they have to cut. The messaging last Wednesday was that they are starting the cutting cycle in September. The conversation today is it 25 or 50 basis points. And ultimately, it's the macro data coming in, less on CPI, less on PCE, and more on employment. So Thursday claims data, that really spooked the market last week, and non-farm payrolls and PMIs and ISM. Those are the numbers that are going to tell us whether it's a 25 or a 50 in September.
I got to say, one of the confusing things about the delay of this Fed is they say we don't want to react on one data point. But I remember when inflation was on the way up, and we got a University of Michigan survey that scared them. And they flipped over the weekend via an outlet saying that we are indeed going to hike. I mean, why are they not doing that this time? They've shown some flexibility in the past, again, off of probably tier 2 data.
Because the data are still good, right? The economy is still good. We just came off an earnings season where earnings are over 11% in the second quarter, 2.8% in the second quarter for GDP. Atlanta Fed GDP now is revised up to 2.9%. So the data that are coming in are not that weak. It's very specifically located certain parts of the income scale, certain parts of the labor force. Now, you have to go where the puck is going, right? So we have to project forward, and I think it's time to cut.
What pushes them to 50? Well, they're already running with an unemployment rate that's higher than their year-end target.
So the thing about the higher unemployment rate is that there's some noise there because it could be driven by new workers in the labor force. As we know, we've had a bolus of workers in the labor force in the last 4 years, and they're coming in, and it is more people in labor force. We saw it in the participation rate as well. That can also drive up the unemployment rate. I think there's noise there, and I think that economists realize that there's noise because of, let's call it, the extra 5 million people in the labor force that may not be picked up in other metrics, okay? So what drives them is not so much the unemployment rate, but the new jobs creation and the claims data. The claims data is about as coincident as you get on what's going on with the labor force.
So out of all the data we have ahead of the next Fed meeting, the CPI data, PCE, jobs data, what are you going to be looking at that would potentially give you the path to know what the Fed's going to do?
Thursday claims data, right? So new claims and continuing claims. The trend does not look good. There is some seasonality there. Education workers sometimes take unemployment during the summer. That if that is the case, that is the case, we should see that roll off soon. And there was some closure of factories over the summer, also seasonal. If that's the case, that should come off fairly soon. But I think any number that's over 250 will start getting the attention of the Fed. And we got there almost last week.
Let's talk about stocks. For weeks, people came on this program, pounded the desk and said, buy small caps. Sticking with tech?
Not I.
Avoiding small caps still?
Not I.
I know not you. I'm not implying you. Just to be very clear, not Alicia. Very clear on that. Did not say buy small caps. We've reset, though, particularly with the Friday and Monday price action. Where do you think we are now? What's the trade at the moment?
So we're allocated to all asset classes. We're not overweight small caps. We thought the trade was early because ultimately, if you think that there's a soft landing and the Fed's cutting, it does seem like a great setup for those companies that are underperforming and have highly levered debt. That's the definition of small cap. The problem is if you think that the Fed's not cutting all that much and they still have floating rate debt that comes due in the next 12 to 18 months, it has to be refinanced. I think what you saw was an index play. You know, everybody was so over their skis on large cap and tech, and the market cap of the top 10 stocks is 5.5 times that of the Russell. So it was like a pachyderm through a needle, right? Like taking the capital out of the top 10 stocks and throwing it at the index, you were gonna get these huge moves of 3 and 4% on the way up, and then you see it on the way down as well. There's just not enough market cap in the Russell. It's idiosyncratic. You have to choose your companies very carefully here. So we're allocated. They will do well in a rate cutting cycle, but if there's any question at all about the real economy, then small cap is not where you want to be.
And there's a big question about that at the moment, particularly after Friday. Looking ahead to, as Alicia suggests, the big one tomorrow morning, which is jobless claims, Thursday morning at 8:30 Eastern Time. Alicia Lovett, it's good to catch up, as always. Thank you. Alicia Levine there of BNY Wealth. Let's give an update on stories elsewhere this morning. Let's cross over to Yahara Hackers, who has your Bloomberg brief. Hey, Yahara.
Hi, John. Oil's recovering along with global markets. Investors are on edge about the possibility of a retaliatory strike from Iran on Israel, with the Middle East region accounting for about a third of global production. Brent crude is trading around $78 a barrel as headwinds loom from slowing demand in China and the U.S. and the potential addition of supply from OPEC+. Hong Kong's flagship airline Cathay Pacific is buying as many as 60 Airbus jets in an $11 billion deal. The carrier confirmed an earlier Bloomberg report that it placed an order with the European plane maker, overlooking an offer from U.S. rival Boeing for 787 Dreamliner jets. Cathay's latest deal is the third with Airbus in 12 months and caps its biggest plane spending spree in more than a decade. The airline also reported a 15% slide in first-half net income, with flight numbers still sitting at around 80% of pre-pandemic levels. And the Paris Olympics are winding down with only 5 more days left of competition. Today, the newly crowned fastest man alive, American Noah Lyles, returns to the track in the 200-meter semifinal after taking home gold in the 100-meter. And Team USA's women's basketball team tips off this afternoon against Nigeria in the quarterfinals. The women's team has not lost an Olympic game since 1992. As for the medal count, Team USA leads in both gold medals and total medals won. That's your Bloomberg Brief. John?
Can I just say that Gabby Thomas made us all look terrible yesterday? Neurobiology at Harvard, gold medal at the Olympics.
It's so unfair. And how old is she? Probably like 20-something also?
It's like beauty, brains, athleticism. It's just absolutely ridiculous.
Yeah, the winner was Noah Lyles, though, saying, like, you're not a world champion if you're just playing in the NBA because you're not competing against the world.
Those comments resurface. I've said that a million times. It's like baseball, World Series.
Ridiculous.
Like, who are you playing?
Yeah, well, Canada.
Yeah,
Canada. Come on, Canada. That's the world.
It's the world according to North America.
Okay. Up next, the Morning Calls plus Pierre Ferragut of New Street on his NVIDIA upgrade. That conversation just around the corner with equity futures continuing to bounce up 1% on the S&P.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This from Barclays this morning. Buy the dip in tech, overweight financials. The latest from them. A lot of people buying that dip in the last couple of days. Equity futures right now on the S&P up by more than 1 full percentage point. Yields climbing higher by 3 or 4 basis points at 393.16. We'll keep revisiting dollar yen for you. I know you're all interested in where that's at. That currency pair at 147, positive 1.8% on the session. Let's get you some morning calls. First up, Wells Fargo raising its price target on Uber to 97 from 91. The firm keeping an overweight rating on stocks, saying it remains a top pick for the second half of the year. The stock is up by 0.4. Your second call from TD Cowen, lowering its price target on Airbnb to 125 from 170. The analyst keeping a buy rating on shares, but pointing to tough comps and headwinds from regulators. That stock is down by 14%. And finally, New Street, upgrading NVIDIA to buy with a 120 price target. Analyst Pierre Ferragu is saying the recent sell-off is a buying opportunity. Pierre joins us now for more, with that stock up in early trading by more than 2%. Pierre, great to catch up with you, sir. An upgrade on this stock after a big correction going into the weekend and coming back out of it. Some wild swings we've seen in that name over the last week or so, particularly. Pierre, why do you think this is a good entry point, a good opportunity?
It's a good opportunity because we had a bit of an overheating, in all the AI-related stocks. We grew a bit more cautious 3-4 weeks ago on the back of that. And you've had like a technical correction of the whole group. And specifically on NVIDIA, our concern was that expectations were basically getting almost like about to be ahead of what the supply chain was, lining up in terms of capacity, and well ahead of CapEx projection, how much money the top players were going to spend on their data centers. And so what happened over the last couple of days is that you've had a lot of news flow about the next generation of NVIDIA chips, the Blackwell generation being delayed. And that actually creates like a very counterintuitive situation where if the next generation chip Blackwell is delayed, it creates a bit more slack, a bit more leeway, a little bit more room for NVIDIA to do more of the older chips. And so we actually think it makes like meeting expectations for NVIDIA safer today than it was a few weeks ago. And of course, with the stock being down almost 30% from its peaks, valuation now is very reasonable. To give you an idea, Jonathan, it's trading on 29 times what we expect for earnings for next year, and we're slightly below consensus. We're very conservative. And, in the last pullback in 2020, this is kind of like the trough multiple at which the stock really got to its lowest point. So we don't see much, downside risk on earnings, no downside risk on the multiple. So it's a good place to get into the AI infrastructure leader.
Pierre, let's talk about the potential downside risk to earnings, perhaps not in the immediate term, but maybe longer down, just a little further down the road. We have heard from their biggest customers. We know who those biggest customers are. And we've noticed just a loss of patience with some investors towards those customers about how much they're spending on their AI ventures and how little maybe the reward is based on things so far. Do you sense that loss of patience from the investor base with their biggest customers? And what do you sense that could mean further down the road?
Yeah, it's an excellent question. This loss of patience, we've seen it already in the past when these customers, moved into the cloud business. They were spending a lot of money to build out the clouds. And at the time, I remember so well all investors being very scared about it because they see all this free cash flow going into additional CapEx and they don't like it. I think it's being a bit short-sighted for investors. They always react like that. These investments are really going into assets that are going to generate additional revenues that are going to depreciate over a long period of time. To give you an example, the CFO of Microsoft said last week that half of the CapEx they're spending this quarter, so they're spending $19 billion. It's a lot of money. But half of that goes into buildings that are going to be, generating revenues and that are going to be depreciated over 15 years. So it's always a bit scary to see very large CapEx. And it's normal to hear investors being worried about it. Now, our view is don't listen to investors. Look at the balance sheet, look at the cash flow statement, and look at the P&L. And when you do that, especially on Microsoft, on which we've done a lot of work lately, what you see is a transition to AI is actually very, very safe. Microsoft has all the means required, of course, to finance it. And the transition to AI is going to cost like a couple of points of gross margin pressure in the next 2-3 years. And you see that the free cash flow of Microsoft is actually already stabilizing, even as a percentage of revenues. So this transition is going to happen without paying for these very large players, which means that they're going to be able to continue to spend as much money as they spend today, and actually they're probably going to keep growing the amount of money they are spending. So we feel relatively safe about this situation.
Still, one of the scary things, I think, for some people, Pierre, is that those big players, it's kind of what NVIDIA's got. Some 20% of NVIDIA's revenue comes from Microsoft alone. Does it have a concentration problem?
Yes and no. You're right, 4 players make about half that market, but only one supplier makes it. So as long as you have more concentration on the supply side than the buy side, it's actually still a good place to be. And you clearly see that in the profitability and the return on operating assets of NVIDIA. It's a very, very healthy business. So from that perspective, I would tell you, no, they are more concentrated than their clients are. Now, on the other side, only 4 players making half your business presents a permanent strategic risk of clients really working out a way to create an alternative suppliers. And you see how Google developed their own chips in-house very successfully and are now ramping millions of these chips at CPU. And you see that all other players are looking at making similar moves. You look at SoftBank investing in GraphCore to try and create an alternative. You look at other startups trying to create an alternative to NVIDIA. You look at AMD and to some extent Intel trying to create an alternative as well. So NVIDIA is in a very strong position, but they need to remain very, very good at what they do, provide a lot of value to their clients in order to maintain this leading position. So far, we see that they understand that. They are very careful about pricing, about bringing value to their clients at every new product generation. And so far, we have to say execution is very good. Like, for instance, you see that today Blackwell is being delayed the next product generation. You could see that as a mis-execution, but the reality is that NVIDIA moved from releasing a new product every year versus every 2 years, if not more, in the past. So in this acceleration, they took a lot of risk, and now they have maybe like a 1 quarter delay. Overall, execution is still very, very good, and it's going to continue to be very, very good for anyone to compete with NVIDIA. Not impossible, but very, very, very difficult.
Pierre, what about heightened scrutiny? We learned this week that the DOJ is going to be looking at NVIDIA when it comes to potentially violating antitrust laws. Any concerns you have about this?
A lot of concerns in terms of a lot of scrutiny, as you mentioned it. I think you're totally right. Look at Microsoft in the last 20 years under how much scrutiny they've been in terms of regulation. Does that mean it's going to hurt the business? Probably not. NVIDIA will have to manage that very carefully. We'll have to carefully choose its practice, be careful about bundling, be careful about pricing fairness, and they'll have to be very careful to behave very well. But if they do the best chip, they do the best chip. If everyone wants their chips, everyone wants their chips, and there isn't much the regulator can do about that. So it's going to be high on the list of topics being discussed in the boardroom of NVIDIA, as it has for Microsoft in the last 20 years.
Yeah.
Does that mean NVIDIA could suffer? Not really.
It wasn't a regulator that beat Microsoft, it was the market. Well said, Pierre. Pierre Farago of New Street. I mean, my words, but Pierre was basically alluding to it. You think about the experience of Microsoft in the last 20 years. That's what did it. If you make the best product, people are going to buy it.
Yeah, but investors, how much patience are they going to give in the meantime? To your point, I mean, we had Super Microcomputers earnings last night, which NVIDIA is their biggest supplier. I mean, crazy earnings. They really, really upgraded their forecast, but margins were kind of off. That thing is getting punished this morning. So in the meantime, investors don't really care if it's the best product. They just want it to keep growing at, 300%.
Yeah, at ridiculous levels. NVIDIA's up in the pre-market by 2%. New Street upgrading the stock to a buy. New price target, 120. We traded about 106 this morning. Coming up next, we'll catch up with Ian Lincoln and Ashok Bhatia on the odds of a 50 basis point cut from the Federal Reserve in September. Their conversation up next.
What's happening on Wall Street?
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep rate World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
So we've said a few times, we're light on economic data. The next big data point is jobless claims tomorrow morning, about 24 hours from now, 8:30 Eastern Time. Andrew Honhorse of Citi with this to say. Initial jobless claims remaining at these levels in August would confirm the slowdown, and a rise to 260 or above would signal deeper weakness. 260. Andrew and the team over at Citi have said a few times, that's the danger zone for jobless claims. Their words. Equity futures right now on the S&P 500 shaping up as follows. We look a little something like this. Drifting higher by another 1% on the S&P. Or the Nasdaq up by 1.25. In the bond market, treasuries taking shape with yields higher by 2 basis points on a 2-year, approaching 4% again. Seen that a few times in the last couple of days. 393.73 on a 10-year, up by about 4 basis points. Curve a little bit steeper, led by a sell-off for the long end. The 30-year up by 6 basis points. If you switch at the board, the one to watch really should have started with this because it set the tone for absolutely everything elsewhere. Dollar yen 147. We're positive on that currency pair by 1.9%. That is a weaker Japanese yen. Here's the why. Under surveillance this morning, the BOJ sending dovish signals after days of historic volatility. The bank's deputy governor saying this: the bank needs to maintain monetary easing with the current policy interest rate for the time being. The bank will not raise its policy interest rate when financial and capital markets are unstable. So no hikes from the BOJ as a conclusion by some. Danny, I think, like others, you're skeptical.
I am skeptical because he saw that big reaction in the yen. He saw that chart that you just showed that had it shoot up. And then we get maybe 30 minutes later, he comes out again and says, I think markets actually will calm down, which again gives him the room to continue tightening and saying, I have no gap with UEDA on policy. We know what UEDA's policy is. He wants to tighten, he wants to normalize, he wants to continue to hike. He talked about that in the meeting last week, that it was coming, one of many. 25 basis points is what we saw. So if you're comfortable loading back into the carry trade, you have to contend with that this is still a BOJ that wants to normalize.
Mohammed Al-Erin was on the program the last hour. Mohammed making the point that if they're capitulating here, if they're placating markets, he thinks they're making a mistake.
Right, because they're basically just allowing the markets to come back in, load back up. Paul Donovan this morning saying Japanese equities, what we've been witnessing, now entirely where they were before the plunge on Monday. So economic fundamentals have not changed that much this week. Draw your own conclusions about markets' relationships to economic reality.
Yeah, this market has just been ridiculous over the last few days. The politics is ridiculous too, but just sort of like spare us just a moment to talk about the politics. Republican presidential nominee Donald Trump announcing Elon Musk will interview him on X on Monday. The news coming just after Vice President Kamala Harris named Minnesota Governor Tim Walz as her running mate. Musk quickly endorsed Trump after the assassination attempt on the former president just last month. I have to say, that assassination attempt feels like a year ago, given how quickly this political cycle has moved.
It does, and I'm looking forward to seeing this interview, but I do have to say 2 things. One, Elon Musk is a firm believer at this moment in Donald Trump, so this feels like it's going to be softballs. I would love to see Trump and Kamala Harris, for that matter, sit down with journalists that are a little bit more unfriendly to them. It's also interesting for Elon Musk. This is potentially a space for him to have a redo, relax. And Don Jr. came out and called it disaster, or disaster, like DeSantis. So for me, this just feels like potentially it's a win for Musk, but it's almost like Reid Hoffman sitting down with Kamala Harris on LinkedIn. You know what you're going to get.
When have US politicians ever sat down with people that don't like them?
They have.
When does that happen? Who? When was the last time that happened?
Trump just did it
Trump
at the
does it.
NEJB. He literally just did it.
So let me rephrase. When do Democratic politicians sit down with people that don't like them?
Yeah, that's probably, well, when do they sit down with anyone? I think we need to ask that question at the moment because we haven't heard with friendly or unfriendly.
That's true. I would also just note, though, that Trump was speaking on a panel event. But yes, many would say that potentially for him, it wasn't the best idea to go into that.
Let's see if we actually get an interview a little bit later this month. We shall see. Let's turn to the earnings. Disney results painting a mixed picture. Weakness in the company's famed theme parks offsetting its first ever profit in streaming. Disney saying its theme park in Paris suffered from a reduction in summer travel due to the Olympics. Streaming earnings continue with Warner Brothers Discovery expected after the closing bout. It was interesting hearing from the CFO the different cohorts of consumers here. Upper income consumers not going to Disney parks because they're going elsewhere. Lower income consumers just pulling back more broadly, yet still they've got faith this thing bounces back in the next 12 months.
The reason I find this confusing is because we've also heard from airlines and from Airbnb and from hotels saying that people aren't traveling as much, that they're not going abroad as much. It's so interesting to get different slices depending on the different company, and you try to wrap your head around what this means for the consumer. I don't know, maybe it's just an excuse at the end of the day that these companies need to recalibrate strategy to make sure people go down to Florida instead of going to Italy, and they somehow have sort of misplaced that in a changing consumer and are just basically blaming it on, I don't know, normalization or a slowdown in consumers.
What the CFO, I think, was alluding to is basically what we've been talking about, is bifurcation of the consumer. The high-end consumer that they really want to come back next year and spend locally, say in Orlando, they're not doing that right now. He says they're off abroad. Interesting for Paris, though. You'd think their numbers would have an uptick, right? If people are going to the Olympics, why not stop at Disneyland Paris?
Waiting to see if this shows up in the numbers elsewhere, particularly jobless claims tomorrow morning. So let's talk about that. 24 hours away from the data at 8:30 tomorrow morning. The first time since the soft July payrolls report, we'll get another sense of the labour market. Investors hoping the data will offer clues about how much the Fed will cut in September. Ian Lincoln of BMO writing the following: our base case remains a 25 basis point cut, with the caveat that this outcome is based on 0.2% core CPI and a stabilisation in the unemployment rate and non-farm payrolls. Ian joins us now for more. Ian, it's good to see you.
Nice to be here.
The rethink of the rethink, with the 10-year yield back at 3.94 and a raise and a drop since payrolls. What is this? What are we doing?
So I think we're in one of those classic moments in financial markets where the prices have changed more than the facts have. What have we learned? We have learned that the unemployment rate was a bit higher than the Fed and the market was looking for, but that's really about it. We've seen what's gone on with the Bank of Japan and the yen, the carry trade, the big unwind. We saw 10-year yields as low as 366, give or take. We're now back up to roughly 395. We have an auction this afternoon. We're going to be in a much different environment by the end of this week than the angst that was in place on Monday.
For people obsessed with asymmetries, given the reset we've seen in the bond market, are we more vulnerable now to hotter data or still colder data? Just what is things set up for?
At this point, we have gone through the peak angst of being more vulnerable to stronger data than weak data. I think we're right in that sweet spot where we can respond with a degree of intellectual honesty to whatever we see tomorrow via claims.
That also sounds like a more volatile bond market, though, if we're kind of sitting at the precipice and can go either way. What does that mean just for my ability to hold bonds and feel comfortable with it, that this is kind of the haven, the thing that offsets other risk assets?
Well, at this point, it is an ideal environment to hold Treasury bonds because the Fed has told us that they're following every major other central bank, with the exception of the Bank of Japan, and moving toward an rate cutting, not necessarily an easing, but a rate cutting bias for, frankly, the foreseeable future. And while that might not be a 50 basis point September move that starts the process, we will get into a series of rate cuts. And so there will be moments, as we have seen, where yields back up as we rethink the rethink, as it were. But at the end of the day, the structural change definitely benefits lower rates.
We're on the curve, though, because this has been a front end that's been scared of the Fed, a long end that's been scared of the economy and the deficit.
I would point to the compression of 10-year break-evens as a clear indication that the market has renewed faith in monetary policy and renewed faith in the Fed's commitment to get us back to that 2% inflation target. And as break-evens compress, we will see nominal rates move lower and lower. And so I like the 10-year sector with a nod to the fact that 2 years are going to be very closely linked to nearer-term policy expectations.
When it comes to policy expectations, you're still expecting 25 basis points cut for September, but potentially the data can move you to 50. But how much do you think they need to cut for the rest of the year? Alicia Levine was just on talking about 100 basis points. How much do you think the Fed, by the end of December, should have in this market?
So our base case remains that if the Fed starts at 25 basis points a quarter, they can continue that cadence only if we remain in a soft, low landing environment. And we're going to know that over the course of the next 3 major data releases, 2 CPIs and that non-farm payrolls, and that will set the tone for September. In an ideal world, 25 in September, 25 in December, quarterly cadence from there. I'm worried that that's not going to be what plays out. I'm worried that we're actually going to see a more dramatic deceleration on the inflation front and another concerning payrolls print. And then we're 25 at each meeting with the note or with the caveat that that could begin with that departure point of 50.
How do you define a concerning payrolls report?
Anything sub 75 in terms of the headline or another 0.2% increase in the unemployment rate that is not coupled with a higher labor force participation.
Ian, just quickly, I'd love your thoughts on the price action. How orderly was this bond market on Monday? What did you make of it?
I wouldn't put it in the category of being disorderly. Liquidity was fine. Everything functioned as it was supposed to. There were no clear strains. We haven't seen any drama unfold in the funding markets. Things seem to be calm for the time being. That being said, as we know, when paradigms and narratives shift this quickly, the price action can be very, very choppy. We reprice, we don't trade tick for tick to a new level.
Things have gone back and forth viciously in the last year, repeatedly. We've seen it time and time again. Ian, it's good to see you. Thank you, sir. Ian Lingham there of BMO. To continue the conversation, Ashok Bhatia of Neuberger Berman joins us now. Ashok, I want to come to you on something you've been pondering for a while. Invest for the destination, not the path. Can you just frame why that was important and why maybe things have started to turn, that the path has become more interesting?
Yeah, I think so. A lot of our thesis for this year was what you said, was own 5 to 7 year points. We were at peak in the spring. Those points were pricing for the Fed to get to a terminal rate of 1 point, almost 4.25. And our view was Fed was going to end up somewhere lower than that. We sit here today, and the terminal rate pricing, at the lows on Friday or Monday, we got down to a terminal rate of 2.90, and we sit here today with a terminal rate pricing of 3%. And that to us seems extremely reasonable. So I think the main thing that's going to have to, and it's going to be a harder question for the bond market, is suddenly the path gets more important. Because the endpoint is priced, I think, pretty fairly, it's now going to be these debates about how quickly they get to that 3% level that's really going to drive bond performance. You were talking with Ian about how much is priced in 25 versus 50. The challenge for bonds is there's over 100 basis points of easing priced in for the rest of the year. And if you don't get that, total return performance in some of these short maturity fixed income securities will be challenging. So I think the structural change that's happened in the bond market, and I think it will persist, is we're going to have to talk more about 25, 50, this pacing and this path, and the destination pricing of 3%. I'd be surprised if that changes an awful lot over the coming months.
Well, the crazy thing about this bond market is you can have a clear view for where that destination is going, but you can be smacked around in the meantime as this market swings back and forth. Do you think there's any merit to being a more short-term trader, that you just have to be tactical in a market like this?
I do. I think, you want to definitely keep, valuation as an anchor on this. But, we saw this in November and December of last year. And, it's kind of history's littered with this, which is when bonds rally, they often rally very quickly and, can occur. In this case, we've repriced 100 basis points or so in the course of a week. I do think, our base case is the next few months. We'll see continued, weak inflation prints. I think we're a little more concerned about the labor market. So I think what that all adds up to is the next few months, we're probably not going to see a big repricing higher in yields. And I think it's probably more going to be, how weak does the data get? Can that drive even faster Fed expectations? But base cases, we've repriced yields, and we're probably just, I think, going to sit around these levels for a while.
The other repricing we did is a market that you like. It is credit. And I mean, there you saw some huge moves, widening of 73 basis points in just 5 days. Sure, it comes in 22 again yesterday, but actually, are you now fairly getting compensated for the risk in this market?
Yeah, I think it's a great point. And, credit spreads, high yield spreads were, 300 coming into this. I think intraday, we probably peaked at around 390. We've retraced some of that. But definitely, this has created some opportunities in high quality double Bs, in some of the longer duration triple Bs, where, names are 25 to 50 wider. Now, I think, yield credit spreads are still pretty low in the grand scheme of things, but there's definitely a little bit more opportunity. And we do think that, if one of the big things that comes out of this is the Fed wants to get to its neutral rate faster, and this will all be an excuse for the Fed to do so, that should actually be a bit more supportive for credit and take out some of the tail risk. So, yeah, the opportunities in credit have appeared a little bit more.
When it comes to what the Fed is doing and the question about the 50 basis points at the meeting, intermarket meeting, how potentially that's also a debate. What are you viewing for the entire rest of the year for basis points the Fed's going to cut?
Yeah, that's the $1 million question here. I'd say the way we're investing is really don't bet against a very aggressive Fed. And I think that's sort of lesson one, which is the Fed knows it's got a restrictive policy rate. The Fed has been trying to get into this period where they can be a bit more forward-looking, and this is going to give them, we think, the excuse to get there. So I wouldn't rule out, and we wouldn't rule out, the chances that, look, if you see, and I know you were asking Ian about a payroll print, less than 75. If you get some of these more downside types of outcomes in the next few months, I wouldn't discount that the Fed can deliver the 100 basis points or even a little bit more if you get that kind of weak data. The Fed, I think, wants to get that first 100 basis points and should get that first 100 basis points of easing out of the way. So it's not a great answer to your question, I know, but I think, 75 is probably the minimum, and the upside or how much easing, it will be data dependent, but I don't think we're going to back off this pricing off an awful lot.
Ashok, I feel like we've been exploring the same thing now for months and months and months. Is it a welcome cooling or an unwelcome deterioration? I can tell you the split on Wall Street. Morgan Stanley, Bank of America, basically saying a welcome cooling. Citi, JP Morgan saying an unwelcome deterioration. Are you in the latter camp and not the former? Is this looking more and more like an unwelcome deterioration?
Don't think. Look, we think this is still a soft landing. It's really hard to get the U.S. into negative type of GDPs. But I do think, we've spoken about the labor market, right? The gains that we're seeing are getting more narrow. 60% or so of the job gains are coming in two sectors, education and healthcare. It's continuing to get more narrow. And that's concerning, that once the cyclical sectors are already weak or weaker, and you get a little bit of weakness in those, suddenly you can introduce more downside to payrolls. So I put us somewhere in this is a soft landing, and that's our view, base case, but it's probably tilting a little bit more towards that lower end of soft landing. But this is not, in our view, a recession outcome.
Got it. Ashok, appreciate it. As always, sir, thank you. Ashok Bhatia there of Neuberger Berman. On the labour market, the economy, and what's developing in the bond market too. In the equity market right now, going into the opening bell about 1 hour and 13 minutes away. Equity futures positive by a little more than 1%. With an update on stories elsewhere with your Bloomberg brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Vice President Kamala Harris and her newly named running mate, Governor Tim Walz, kicking off their swing state tour yesterday in Philadelphia. Harris introduced Walz on stage, hailing him as a fighter for the middle class. The campaign saying they raised more than $20 million since the Walz announcement yesterday morning, which they hailed as one of their best fundraising days. Harris and Walz will be in Wisconsin and Michigan today as they continue their battleground tour. Shares of Airbnb are plunging in the pre-market, down more than 12%. Bookings in the second quarter came in lower than expected, and the company gave a disappointing outlook, setting it up for the slowest pace of growth since 2020. It also warned of slowing demand from U.S. vacationers despite it being peak summer travel season. One area that saw positive results was bookings for larger parties after the company retooled its marketing toward groups choosing multi-bedroom homes over hotel rooms. And a group of U.S. senators, including Elizabeth Warren and Bernie Sanders, have sent a letter to the Department of Justice asking it to investigate the newly formed Venue sports streaming platform. That's according to a report from The Athletic. The platform is a joint venture by Disney's ESPN, Fox Sports, and TNT Sports to provide a direct-to-consumer service. But the senators have reportedly asked the DOJ to investigate whether it violates antitrust or telecommunications laws. That's your Bloomberg Brief. John?
Yeah, Hara, thank you. Thanks for this morning. Up next on the programme, setting you up for the day ahead. We'll get you the trading diary, the calendar for the next couple of days. You're watching Bloomberg TV.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
The guiding light for this market right now is dollar yen. So I'll tell you where dollar yen is first, and then we'll take a look at everything else. Dollar yen right now, just short of 147. That currency pair has moved by about 1.8% in today's session. That's where we are at the moment, given a nudge by the Bank of Japan Deputy Governor. That gives a nudge to all of this. Equities up by more than 1% on the S&P 500. Treasuries down and yields higher, up by 3 basis points, 392.78 on a US 10-year. As we count you down to the opening bell, about 1 hour and 9 minutes away, let's get to the trading diary, the calendar for today and the rest of this week. Vice President Harris and Tim Walz hitting the campaign trail, holding rallies in Wisconsin and Michigan this afternoon. J.D. Vance planning to mirror their route throughout this week. After the market close, we'll get some results from Warner Brothers Discovery, and tomorrow, another round of jobless claims for some Fed speak from the Richmond Fed President, Tom Barkin. Joining us now to talk about all of this is Bloomberg economics and policy correspondent Mike McKee. Mike, good morning to you, sir. Light on data, light on Fed speak. What do you make of what you've seen and what you've heard so far this week?
I think it's been a kind of classic market overreaction to things, and then misunderstanding of where the Fed is from some people on Wall Street who've called for this emergency rate cut or a 50 basis point announcement or something like that. Tomorrow we get jobless claims. It's going to be the one number that everybody cares about this week. And I have a chart that kind of gives you pause. When you consider what's happening with jobless claims, I mean, we're looking for a slight drop, but it's possible they go up again. But when you look at the non-seasonally adjusted and seasonally adjusted rates of jobless claims. The blue line is seasonally adjusted. That's what we report. The white line is non-seasonally adjusted. And look at the difference. Look what happens every July. Claims go way up on a seasonally adjusted basis. And look what's happened this year. Not only is the same pattern being followed, but there's a great divergence between the two. And that may be in part because of additional people coming into the labor force and new seasonal adjustment factors post-pandemic. The Fed is only going to act if they see a serious, real problem with the labor market. And maybe this is not telling us there is one.
There's so much blame going around at the moment. The Bank of Japan, the Federal Reserve for not cutting the interest rates. I mean, pick your poison. Some people even blaming Kamala Harris, which I have to say, I find that absolutely ridiculous, just sort of bonkers. I thought it was kind of ridiculous how many people thought it was Trump at times and now it's Harris. The whole thing's nuts. Yeah. Let's park that. Ed Yardeni blaming the weather. Can we talk about the weather a little bit more?
There's a lot of people who are blaming the weather. And even Mary Daly was talking about the weather when she was speaking the other day, because yes, the BLS says it wasn't the hurricane, and we have no reason to doubt their reasoning on it, but there were 436,000 people who couldn't work because of weather. And so there was something going on. It may not have been right in Texas, but maybe around the country. So there is the chance of a big snapback in the August numbers when we get them in September. We don't know, but there is that out there.
When you look at something like ISM services this week, where the employment part is quite strong, how much do you actually want to read into that? Or do you say this is just like a small segment of the economy and I can't extrapolate it for the data to come?
Well, it's a big segment of the economy. It's a small survey, but it's also a sentiment survey. It's what purchasing managers think is happening in their company, and they're telling us that they're not letting people go at this point, and it doesn't suggest that they're going to be hiring a huge amount of people, but as long as they're retaining the people who are on their payrolls, then that squares with what we're seeing with jobless claims. And services, obviously, the biggest part of the economy, so that's an important number. Would have been interesting to have that before the payrolls report last week. It wouldn't have kind of matched up.
We're waiting for jobless claims then. Tomorrow morning, 8:30 Eastern time. Just to give you a sneak peek of our survey, our estimate, our median estimate in our survey, 240,000, which would be a drop back from the previous week's reading of 249. So we're looking for 240 tomorrow. This is going to be a key feature of our programming tomorrow morning. Given we're so light on everything else, there's going to be a lot of weight put on this number following the soft job print on Friday, on payrolls Friday, and we'll see what we get in the market in response to it. Our lineup looks like this. We'll catch up with Seema Shah of Principal Asset Management, Sarah Wolf of Morgan Stanley, Tony Rodriguez of Nuveen, and Samir Samana of Wells Fargo. All of that still to come as we count you down to the opening bell, about 35 minutes away, with equity futures positive on the S&P 500 by a little more than 1%. From New York City, this was Bloomberg Surveillance.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What would you say somebody young who's watching this should do if he or she aspires to be like you?
There's one component of our industry that people need to focus on, and it's not technical, and that's communication skills. Focus on being a phenomenal communicator, invest in that. Think about it, we have to convince a company to sell to us. You just don't walk in and buy the stock or tell them, yeah, you're for sale, I'll pay you this price. That takes years of relationship and effort. Why would somebody sell you that billion-dollar software company growing at 20%? Just because? No way. People hang on to these great assets. And then how do you get on the same page with the executive team of that company, even if they're existing or new? It requires just amazing communication.
If you go to a cocktail party and somebody comes up to you and says, I have $100,000 I'd like to invest, what do you would recommend that that person do with $100,000? What do you think is a good idea to do with $100,000 today?
Sometimes they do, and I give them the most boring answer ever. S&P 500.
Just buy an index.
Buy the index. You don't have to worry about the quarterly earnings of a company. Did something change? Did somebody change management? You don't have to make this your full-time job. Just buy the index and you're going to be okay.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of, I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
Japanese dovishness drives futures higher in the U.S. 30 minutes until the start of trading. Here, I'm Matt Miller.
I'm Sonali Bassett. Katie Greifeld is off today, and Bloomberg Open Interest starts right now.
Coming up, dovish signals from the Bank of Japan give fresh legs to the recovery in stocks globally. But worries remain. Disappointing earnings reports continue to pile up, with Disney and Airbnb showing weakness for the U.S. consumer. Over the next 2 hours, we're going to get the view from the C-suite as well, from Rivian CEO RJ Scaringe, Resi CEO Pablo Rivero, and MicroStrategy's Michael Saylor. Let's take a look at where markets are trading right now. You've got futures higher by more than 1% on the S&P 500. On the NASDAQ, we're looking at a 1.4% gain. And as Sonali just pointed out to me, we're seeing treasuries almost back to 4 on the 10-year.
On the 2-year, back to 4, but the 10-year also on the rise. Certainly, we have erased a lot of the gains that we saw this week. But let's take a look at what else is erasing gains. That is Disney, showing weakness in its park business, overshadowing its streaming profits. Disney down now about 1.7% off the lows of the pre-market, but still down nonetheless. Let's flip up the board here and take a look at some other earnings from this morning. Airbnb down more than 12.6%, points to weaker demand here based on its outlook. Bookings also weaker than expected. If Airbnb continues to drop, you could see a record drop, so keep an eye on that stock. Lyft down more than 13.6%, similar issue here. Bookings on outlook missing expectations, and Rivian down another 9.3% pre-market. Second quarter revenue missed estimates, with cash burn being bigger than expected. You're not going to want to miss it. Tune in a little later with our interview with Rivian's CEO coming up in just a few minutes, Matt.
Yeah, very much looking forward to that. Let's talk, though, about the markets. Goldman Sachs CEO David Solomon sees more jolts ahead as the market reorients itself. He spoke on an upcoming episode of the David Rubenstein Show, Peer-to-Peer Conversations.
I think we're going to see more volatility in the short term here. This was a pretty big, pretty meaningful correction and a big unwind of leverage, as we have discussed, in certain parts of the system. My guess is we'll see a little bit more rebalancing. But my base case is still that there's a good chance the economy is still in reasonable shape.
All right, joining us to talk about this is Brian Levitt, global market strategist at Invesco. And Brian, he spoke with David before the Bank of Japan came out and essentially offered a jawboning put, right? Saying that we're not going to raise rates anymore if markets are volatile, like now.
Yeah.
what do you think that means for the carry trade? Because that was at least one of the reasons that we saw the big collapse in prices on Monday.
It did seem like a big overreaction for one rate move that you probably could envision for the first time in Japan in a long while. And the reality is, anytime you get volatility in markets, it tends to be the result of policy uncertainty. Usually it's centered in the United States with the Federal Reserve. This time, the uncertainty of just how high the Bank of Japan may raise rates. I always thought it was an overreaction. This idea that after fighting deflation for a few decades, we were going to see Japan raise rates significantly was probably an overstatement. I'd say instead it was the market looking for an excuse to pull back.
Was it an overreaction, or was it just a classic deleveraging? It's interesting. I think it's fair to point out that that carry trade doesn't just exist in the yen. Some strategists pointing out this morning as well that the yuan is something to keep an eye on as well. Can you see more deleveraging ahead?
Yeah, so I agree that it's deleveraging, but it was an overreaction to assume that it was going to keep going. To think that, once that leverage was taken out, once that was covered, that the Bank of Japan was going to keep raising rates and it would no longer be a funding currency. It seemed overstated given the dynamics, given the structural position of the Japanese economy.
In terms of the U.S. economy, it seems like we're still seeing some pretty significant growth, right? At least in Q2, 2.8% is nothing to sniff at. And as Mike McKee points out to us often, the Atlanta Fed is forecasting 2.5% in Q3. Are you worried about the unemployment number?
Not worried about it. What I would suggest is we're slowing. It looks like, if you look at the leading indicators, we're below trend. It's pointing to below trend growth and slowing, but certainly not to levels that people would worry about if they were forecasting a recession. I mean, you see the unemployment rate moving up. You see things like the ISM manufacturing survey going down to 46. These are all signs of an economy slowing.
Well, in the earnings reports that we got yesterday from Airbnb or this morning from Disney, it seems like people aren't shelling out cash to go to the House of Mouse.
Look, sometimes you have to be careful what you wish for. When we were sitting here with 9.6% inflation rate, the concern was that the consumer was just not slowing down, and we were booking Airbnbs and we were going to the parks and Disney because we hadn't done anything in a few years. We had saved some money and we wanted to enjoy some experiences. So we can't have it both ways. We knew the consumer had to slow down. The question now is just how slow does the consumer get? And for the most part, the consumer is in reasonable shape. There's no reason to believe that this is a consumer that's about to crater. But that's the concern I think some people have.
2 days ago, there was a much more drastic expectation in the bond market on how fast you would see those cuts, people even calling for that intermeeting cut. And we were talking about this idea that the 2 years already flirting with 4% again. And if you see rates not come down as fast as perhaps the market would like, then how much weaker does that consumer get going into next year?
Yeah, the longer that rates are elevated, the more challenge for the consumer. So I've been saying now for a while that I wish the Federal Reserve would get out in front of this. I believe that the inflation story was way behind us. Typically, when you see inflation roll over, it doesn't spike back. It was a pandemic challenge, right? Blame it on whoever we want. It was a pandemic challenge. So inflation was no longer the problem. The Federal Reserve should be easing. They should, and that's what the 2-year has been telling us. Now, maybe not as much today as 2 days ago, to your point, but the Fed should be easing, starting to take some of that pressure off. The good news is, though, it's not an over-levered economy.
Well, I was just going to bring that up because Sonali's worried about the embedded leverage in the economy, but it's really at the financial level, right?
All I'm saying
banks.
No,
I think it's fair.
A huge moment to realize there was more leverage than we realized.
Yes, and we're still trying to measure the size of the carry trade. But in terms of the economy, mortgages, the consumer, which is obviously the biggest part, you're not worried about a real recession here, or at least a big drop.
80% of Americans have a 30-year fixed-rate mortgage. 90% of Americans have a fixed-rate mortgage of some maturity. So most Americans are not feeling it. Now, yes, credit card balances have increased. I've joked that was all just Taylor Swift tickets last summer. But balances have increased. But if you look at servicing them as a percentage of personal income, the consumer looks
fine. So, no, I'm not overly concerned about a significant deterioration in economic activity.
To that end, also, Torsten Slok over at Apollo was out with a great note this morning to the point that you've been making, that this drop or the rise in unemployment rate was due more to the rise in immigration, increasing labor supply here, rather than it was a number of job cuts really hitting the market. What does that mean for the way you read the unemployment reports moving forward?
Well, I think we say that every time, though. So we've got to be a little careful, because what you find with the unemployment rate is once it starts to move, it doesn't come back. It goes in the direction that you don't want it to go. That's what tends to happen. And so that's why I would like to see a policy response. Now, what does it all mean for investors? We just did an 8% decline. We do those almost every year, right? So 5 to 10% you recover in 3 months, right? Not a big deal. Now,
and you were already telling your clients to get defensive at the end of last month.
We were, and a couple of days of small cap rally hurt my feelings a little bit, but I'm happy we were telling people to be a little bit more defensive until we see the Fed step in, more of a normalization of the yield curve. But, you know, if you have a recession, you're looking more like a 20% decline, and it might take a year or two to recover. So that's really what we're grappling with if we want to put it into bigger terms for investors, at least from the broad market. So this feels like a garden variety correction. Right? I would need to see credit spreads blow out far further than they are right now. I would need to see leading indicators of the economy deteriorate far more significantly to be more concerned that this becomes something more significant.
Matt will lose his mind if I start forcing credit spreads pre-market.
I like IG credit spreads. That's a very good point. Those are your canary in the coal mine, essentially.
Those are my canary. You know, they don't use canaries in coal mines anymore, if anybody was worried about it.
That's good.
We certainly need them
I think
for this
that's a
market,
good thing,
however.
right?
Brian, we got to leave it there. That is Brian Levitt of Invesco. Now we have some breaking news that we want to point out to you. The Consumer Financial Protection Bureau announcing a probe on JP Morgan, Wells Fargo, and Bank of America over Zelle scams. It's a broad and nature type of probe here, according to the Wall Street Journal reporting this morning. According to people familiar with the matter, JP Morgan had disclosed that it was responding to a CFPB inquiry, and other banks are expected to disclose their contact as well, Matt.
Right. They're investigating not only those banks, but all big banks and Zelle scams. And I mean, this is their job, right? This is what the Consumer Financial Protection Bureau was set up to do. So,
and at the end of the day, you know, more people are transacting online. Zelle is a third-party service that they're using, so all banks are now being.
That's right, and we're looking at about $10 billion in scams in the U.S. economy alone per year. So it's become a serious problem, and it's growing quickly. I think it was $8.8 billion in the year before. So it's getting worse and worse, yeah.
Yeah, it certainly is.
All right, another quick check on futures here. They're getting better and better. You can see the S&P futures up 1.2%. The NASDAQ futures up a little bit more than 1.4%. And the small caps gaining back a little bit. They had lost almost everything from that great rotation last month. Will they add to it? Let's get a look at the stocks moving ahead of the opening bell. The individual names for that, we go to Abigail Doolittle. Abby?
Well, Matt, let's start off on a stock that is certainly helping the futures this morning, and that is Lumen Technologies. Take a look at the stock, absolutely soaring up more than 40% in the pre-market. Now, interestingly, they put up a bigger loss than expected, a small sales beat, but most important, their free cash flow forecast off the charts. Investors really liking it. It looks like AI demand is helping out this telecommunications company. Let's take a look at an earnings mover to the downside, however, and that is Super Micro Computer, right now down about 14%. There was a 25% earnings miss on very, very disappointing gross margins. There were supply chain constraints in liquid cooling, plus a large customer mix. They actually boosted the sales outlook, but investors looking past that. And then in terms of why those futures are truly higher, at least relative to the S&P 500, the NASDAQ 100, take a look at the three most valuable companies in the world, Apple, Microsoft, and NVIDIA. Actually, I don't know about NVIDIA if that's in the third spot anymore, but in any case, big tech is making a comeback. I would point out, though, that, Matt, Apple lagging, that is the key stock to take a look at here in the days ahead to see whether or not the pullback has abated.
All right, you've been keeping your eye on Apple. We'll continue to watch that as well. Just above $200 right now. Abigail Doolittle, thanks very much for that. Coming up, Rivian's second quarter missed estimates slightly. I mean, we're talking about $1.16 billion in revenue instead of $1.17 billion.
Market doesn't like it, though.
In revenue, but the market doesn't like it. Maybe the cash burn is worse than expected. We'll talk to the CEO, RJ Scaringe, next. This is Bloomberg.
The names that move markets are on Bloomberg.
You know, with all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. You know, look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time we have to constantly resurrect this spirit of resilience.
But are you hopeful that
I'm always hopeful. Oh, come on, we have to be. We have to be.
Bloomberg. Context changes everything.
Let's get to high interest now. A look at what's making headlines around the world. Bangladesh's president and security chiefs met the demand of student leaders on Tuesday to name Nobel laureate Muhammad Yunus as the country's transitional leader after mass protests led to the resignation of the country's prime minister earlier this week. The high-profile intellectual previously pioneered microloans to fight poverty. We'll be watching him closely. Vice President Kamala Harris is stepping up her efforts to bring rank-and-file union members in swing states back to the Democratic fold. She's being joined by her newly named running mate, Minnesota Governor Tim Walz, at rallies in Michigan and Wisconsin. And United Auto Workers President Shawn Fain is expected to join in Detroit as well. And more than 24 packages of cocaine were found on a Florida beach, according to U.S. Border Patrol. That's because Hurricane Debbie's strong winds swept them there from somewhere. Sustained gusts of 74 miles per hour blew 25 packages onto the Florida Keys, where they were discovered by a Good Samaritan who handed them back to the police. Now, we are watching Rivian stock this morning. It is down pre-market after the EV maker's second quarter revenue missed analyst estimates by just a tiny hair. Cash burn for the quarter, though, also came in bigger than expected. And this is the worry with Rivian. Joining us now is the founder and CEO, RJ Scaringe, as well as Bloomberg Technology co-host Ed Ludlow, who covers the EV market so closely. RJ, I want to ask you just quickly about the sales. This is no doubt a hot product. I mean, I have been fascinated by the car. I love the design, looking at it for years, and people wait in line to get them for a long time. Why are sales only growing 3.3%?
Yeah, I mean, it's great. As you said, it's great to see the reaction to the products. And we see that both through the excitement of our customers directly, but there's lots of ways to measure this. And we just had J.D. Power does an annual appeal study. We came out as the #1 brand this year. We had a #1 ranking on a J.D. Power study last year. So the reaction to the product's been great. We've in the second quarter we went through a big refresh to the product where we've now launched what we call Generation 2 of that vehicle, of the R1T and the R1S, where we made significant improvements in the product, but also took a tremendous amount of cost out of the vehicle.
RJ, the kind of summary of the earnings print was that all of the guidance previously issued was reiterated, and there's a lot of positivity around that. Very simply, loads of people asked me to ask you, can you define what modest gross profit means, or what you're defining it by in order to achieve it?
Yeah. I mean, ultimately, this has been the central focus for us as a company, as a business, is driving cost efficiencies into everything that we do, into our bill of materials, into how we operate and run our plant, and ultimately driving towards getting our production of our R1T and R1S to positive gross margin, ultimately to have the business get to positive free cash flow and profitability. So there's a whole series of steps we're making along the way in terms of improving costs, but the biggest singular step that we've made is what we did in the second quarter. We took the plant down for about a month, while we made meaningful changes to the operations, and importantly changed a significant portion of our supply base out to new suppliers in conjunction with a number of design improvements. And all of that comes together to take us to a place where the incremental contribution of every vehicle we sell is positive, and that's that's what we're driving towards. That's where we continue to guide towards for the fourth quarter of this year.
In the first instance, oh, sorry, Matt, I was just going to hold RJ to account on that one and say, in the first instance, is it just like more than zero or single digits gross profit? Just, I think that's the answer we're looking for.
We haven't provided a specific number, but certainly by saying it's positive gross margin, it's more than zero. Our objective, what we've guided to for a long time, we continue to maintain this guidance, is the long-term margin profile on R1 should be around 25%. And so that's what we, beyond just this fourth quarter performance that we're tracking towards, seeing how we continue to improve in 2025 and beyond, we still maintain confidence in the 25% gross margin.
And the gross profit on vehicles has nothing to do with the credits, but with credits you can make a lot of money, as we've seen in the case of Tesla. You're making double-digit millions there. Do you expect that to grow considerably? Is it really part of your financial planning?
Yeah, I think as we design the business and think about how we're operating the company, the credits environment is certainly something that's a helpful tailwind, but we don't design the company or the business or a strategy around it. It is worth noting, though, that we're seeing the credits environment really become a lot stronger as a number of existing or legacy manufacturers dial back or walk back from their electrification strategies, and we see that as further. I mean, the most important point here is it further amplifies the need for more product in the marketplace. There's very, very little choice in the sub $50,000 price range, and we see that with just the dominant market share position that Tesla has with its Model 3 and its Model Y. Customers need choice, and so this is why we're so excited about the R2 program, because we think there's a tremendous amount of latent demand that wants to buy a vehicle a lot like an R2, wants something that's less than $50,000. In that product when it comes to market. It hopefully answers that need.
RJ, for most of the time that you and I have known each other and we've talked, Rivian has been in a position where it's been supply constrained. I wonder if that's still the case on the R1 refresh. You talked last night as a big factor towards gross profit being ASP, essentially, that these higher performance spec R1s are going to put you in a wider range of price points. But that will be a contributing factor. Is there a backlog, essentially, for R1? Are you supply constrained in that sense?
I mean, it's an important point. We've with the relaunch of what we call the Gen 2 R1, it's not just cost down. We've also added some new packages. We have a tri-motor, our new next generation quad motors, extremely high performance. That's allowed us to stretch the pricing band from our base, roughly $70,000 vehicle up to over $100,000 for our quad motor. And what that's really helpful in doing is helping to drive continual, sort of maintenance of that high average selling price. So this is something that we also continue to have confidence in. It does reflect, as you pointed out, that there's a backlog of interest and excitement around the product. And today, one of the things we're focused on is making sure that the tri-motor and the quad motor ramp meets customer demand. Those are the higher price variants. They're great for driving ASP. They're also the products that a lot of our early adopter customers really want to get. They want the best version of the vehicle that we make.
I want a quad motor. Over 1,000 horsepower with this vehicle. I think it starts at around 100 grand if I want the highest trim level, RJ. I would have to borrow money to buy that. How important is it for you that the Fed bring rates down into the next year?
I mean, ultimately, we watch this extremely closely, and just the overall macro environment that we're in, an interest rate environment, it does have an impact on folks that are buying vehicles that are of this price point, $80,000, $90,000, $100,000 vehicles. It's hard for us to predict exactly how that's going to play out. We, much like in the credits environment, we work really hard to make sure that our business is not dependent upon ultra low rates, but it certainly affects anybody who's selling products that have financing associated with them.
RJ, you gave really early heads up to investors that you're going to shut down normal for about a month for splicing the plant, right? Accommodate for R2 install. That's a long period of time. Thinking back to April, the 3 weeks, I know you're not going to tell me a number for production for 2025, but could you extrapolate out whether it's higher or lower than the base of 57,000, given that 4-week period you outlined?
The decision to put R2 in normal was one that's going to ultimately provide us around $2.25 billion of capital savings in terms of reduce the amount of capital necessary to launch R2. So that was one of the big drivers. The other is it allows us to have really high fixed cost absorption between R2, R1, and our commercial vans in a single plant. Now, of course, to do that, it does require us, as you said, to shut down the plant for a period of time. What we've provided guidance on is to say in the second half of 2025, we'll be shutting down the plant for about a month. And that will impact production. We've guided to say 2025 will grow relative to 2024. We haven't been overly specific around the exact numbers of vehicles we produce, but it will be another year of growth for us.
RJ, when I was a kid, some of the cooler guys had a Scout International truck in the high school parking lot. I always thought they looked so cool. And Volkswagen is reviving that brand. You're working closely with Volkswagen. My immediate thought when I saw that story was, wow, they could just take a Rivian and rebody it as their new Scout. Is that anywhere near part of the plan, or what kind of vehicles can you build together with VW?
Yeah, the Volkswagen partnership is something we're really excited about, but the focus of this is around leveraging our network architecture, our topology of computers, topology of electronic control units, the ECUs in the vehicle, and then, of course, our software stack. It does open the door to other types of partnership and activities we could be doing with Volkswagen Group, but to date, the core focus, the singular focus is around our software and electronics technology.
All right, well, we look forward to any news that comes out on that. RJ, thanks so much for joining us. Really appreciate your time today. RJ Scaringe there of Rivian, as well as Bloomberg Technologies anchor Ed Ludlow, who also is essentially the EV reporter for us here across all of our platforms. This is Bloomberg Open Interest. A quick check on futures shows that we continue to see more than 1% gains, pretty much the same as it looked 10 minutes ago. The market open in 3 minutes' time. We'll talk to Nancy Tangler of Laffer Tangler Investments today as well on what she expects the market to do. This is Bloomberg.
What's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google Public, so I had a little sneak preview.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. Let's take a look at where futures are trading. Right now, more than 1%, 1.2% on the S&P. This has been pretty steady for the last at least half hour, 1.5% on NASDAQ futures. So the rebound essentially continues, even with jumps like this. And yesterday's 1% gain, we still haven't made back all 3% to 4% losses that we saw on Monday, and especially if you put them together with Friday. But it's better than a stick in the eye, as my first stockbroker used to say. You can hear the New York Stock Exchange bell there, rung by Abbott down here on the NASDAQ. You have Hellport AI ringing the bell. A quick check on the major averages as we get into the swing of things today, and you see, sorry, let me move this way. You see essentially what you saw in futures, 1.1% gain on the S&P 500. The NASDAQ up 1.5%. The small caps doing pretty well today also. The Russell 2000 up 1.33%. In terms of the stocks that we're watching closely at the open, Lyft and Rivian, you know, we just spoke with the CEO of Rivian. Right now they're down 9%, so getting punished pretty badly for a slight miss on revenue and a bigger cash burn than had been anticipated by analysts in our survey. Taking a look at Lyft right now, down 18%. That is rough. Being second to Uber is no good after those earnings come out. Shonali, what are you looking at in terms of, I think, really the consumer that's getting hit?
Absolutely. Some brutal moves in consumer-focused stocks reporting this morning. You have Airbnb now down almost 15%. You can see potentially a record drop down in Airbnb shares today. Also, Disney seeing a drop of more than 3.2%. Both companies showing signs of weakness in the consumer. Airbnb bookings missing, and Disney showing weaknesses in their experiences business. Also watching Supermicrocomputer falling, disappointing gross margins over there, overshadowing an otherwise strong 2025 net sales forecast. Supermicrocomputers now down 12.5%, 13%. Let's take a closer look here with Bloomberg's Abigail Doolittle.
Yes, it is the worst day, Shonali, going back to April 19th. So take a look at this nosedive, down 13%, as you mentioned. It has everything to do with those gross margins coming in at 11.3% versus the estimate, or versus 17.1% a year ago. So basically a 400 bip drop in gross margins. However, that forecast that Shonali was just talking about, let's take a look at the big growth here, because we will see that revenue is really expected to grow. This year, revenue is expected to grow more than 100%. Next year, very strong growth, I think around 70% or so. In terms of the overall AI chip space over the last month or so, though, there's been lots of bumps. Let's check in on a number of these stocks. And, well, we've got lots of red on the screen here. This is pretty interesting because if we were to have done this about a month or two ago, this would not have been the case. NVIDIA down 14%, AMD down 22%, ARM down 34%. And then, Matt, here is that super microcomputer in this over the last 30 days, down about 36%. Really pretty extraordinary.
Yeah, absolutely. But if you have that kind of exposure to an industry that gets hit so hard, a lot of people think AI is a bursting bubble, Abigail, and the NVIDIA doesn't get punished as much as the smaller players like SMC. Abigail Doolittle, thanks very much for that. Let's talk about whether or not AI is a bubble. Is it sustainable in terms of these levels, valuations, even after the big drop, or especially after the big drop that we've seen? Nancy Tegler joins us, CEO and CIO at Laffer Tangler Investments. Nancy, you all had leaned in pretty hard to this. I know that you lightened up a little bit in terms of your big tech holdings, thankfully, previous to the last few days of drops. But what do you think about the potential of AI? I mean, are we over-investing? Are we going to see ROI?
I think we are, Matt, and thanks so much for having me. You know, I look at the company's CapEx budgets, and I see it a little bit differently than the street does. First of all, these are smart management teams. They're not going to invest billions, tens of billions of dollars in something that they don't think they can monetize. But more importantly, one man's CapEx spending is another man's revenue. So I think you want to be in the right spots, clearly, and we can just see that in the consumer space between Uber and Lyft. It matters which companies you own. You know, happily we own Uber and we don't own Lyft, but it doesn't always work out that way, by the way. But I do think you want, if generative AI doesn't work, then the market has much bigger problems because it's really permeating across sectors. I just gave a speech on this at the Money Show in Las Vegas, and the use cases are exploding, and it's not just within technology. I mean, I know most people know that, but it's financials, healthcare, industrials, and so you really need to see this work, and we think it will. Last thing I'll say is, you know, I was managing money in the 1990s, poster child of excess valuation, Cisco Systems, closed out the decade at 100 times earnings. John Chambers, who was the CEO, has said that he believes, and I think he's right, that generative AI is bigger than both cloud computing and the internet combined. So stay tuned. I think we're in early innings.
More on the consumer here, Nancy, because you're seeing Airbnb really drop to record levels. You're watching it drop the most since it went public. And Airbnb, Lyft, these are a generation of companies that went public when interest rates were ultra low and when the consumer was very, very strong, flush with cash, really. Do the dynamics change, or is this just a knee-jerk reaction you're seeing? A lot of fear around that consumer causing these stocks to fall more than they would have if that fear wasn't there.
Yeah, I think you're right, Shonali. I mean, if you look at every company that has just modestly disappointed, I mean, take Microsoft. The disappointment was Azure was growing at 30% versus 32%, and the market sold it off. I think the market is looking for an excuse to take a number of these companies down when they disappoint. I don't think either one of these companies is in dire straits. They are in a different position than the large cap tech companies who are actually benefiting from higher interest rates because of the cash on their balance sheets, just kind of, you know, printing money, if you will, from the interest income. So I think you just want to be adept. Some of these will be buying opportunities, and some of them will be dead money that you want to stay away from for some period of time. Only industry leaders with the best management teams.
Nancy, you referenced the 1990s. I was there too. You've been in this business for a long time. When you look at these summer swoons, and you think about investors who are in it for the long haul, not, you know, tactically trading, but holding a portfolio for 5, 10, 15 years out, are these always good times to buy?
Yeah, absolutely. We're having a sign made for our office that says volatility is the friend of the long-term investor, because historically, just look the last 3 years. In 2022, it made sense to add to holdings and add risk back into your portfolio, which is what we were doing. 2023, we got another summer swoon in technology and growth stocks in general, and now we're seeing it again. I think, you know, you can't underestimate the power of the hedge funds and the hedgies going to the Hamptons and pulling some of the volume out of the markets and increasing volatility. Then you've got this, you know, the carry trade issue. But at the end of the day, it made sense. I mean, we had some real big pullbacks in the 1990s, but the NASDAQ was up 820-something%, and the Dow and S&P were up about 450% with higher interest rates. So 10-year between 5 and 8%, with higher inflation averaging around 3%, a labor shortage. What we haven't talked about, and what I thought was the bright spot from last week, is productivity. It came in well ahead of expectations at 2.3%. It was revised up. And that's, that put pressure downward on unit labor costs, which will put downward pressure on inflation. Chairman Greenspan understood that. And so let's hope that this Fed does, because you can have, a GDP now of 2.9%, as it was recently revised up to, and you can have growth that is less inflationary than most people would expect.
Nancy, it's worth talking more about the macro. We're talking more about positioning. But another example here that I think is pretty fascinating is you look at a market in search for options. And on the flip side, you see some major pain in some of those consumer-focused stocks. You see Lumen Technologies, after a 90% surge yesterday, another 40% this morning. And I wonder how much money is just flocking to the AI names that work and bursting valuations to a place that maybe are unsustainable.
Yeah, see, I think that's the point, Chanel. I mean, that's what always happens when you have emerging technologies. And we learned that painfully at the end of the 90s when you had, analysts measuring eyeballs instead of earnings. And I think at the end of the day, stocks trade off of earnings. So in the near term, we have all these other, sort of shocks that drive the short-term returns, but long-term, companies trade off of earnings, and you need to own the companies that are going to survive this. And so, as obvious as it sounds, you want to own Microsoft because they'll buy the competitor that's leading edge. And they have leading edge technology themselves. But those are the kind of places where I want to hide. If you think the economy is slowing, and the GDP now number will go up and go down between now and the end of the quarter, but it is slowing. The labor market is softening. You want to own the reliable earners. And if you look at consumer stocks, as you pointed out early, Pepsi, and Procter & Gamble, they have no more pricing power. And their earnings growth is going to be mid-single digits, and they're trading at 21, 24 times next year's earnings. I'd rather own Microsoft that's growing 15, 16% at 31 times earnings, just as an example. So it matters. You want to stay away from the new fractional companies.
Nancy, we thank you so very much for your time. That is Nancy Tengler, CEO and CIO at Laffer Tengler Investments. And it's interesting, Matt, it's not just Lumen that is rising today. You actually have every company in the Philadelphia Semiconductor Index rising this morning. The SOX is up more than the rest of the market, up more than 3%.
Yeah, good breadth today. I noticed 434 stocks are up right now in the S&P 500. So really ripping. This is Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
This is Open Interest, and a quick check on stocks this morning, ripping as we've been talking about here. S&P 500 up more than 1.4% with a broad-based jump in most of the stocks in the index. NASDAQ 100 jumping even more, 1.8% higher. Those small and mid caps also seeing some love, Matt, 1.4% higher.
All right, let's get your top calls for you. Some of the analysts' action in focus this morning. First up is Loop Capital Markets cutting Trex to a hold. The outdoor decking company lowering its sales outlook for the full year. The Loop analyst says headwinds are more significant than had been anticipated. Next up is TD Cowen cutting its recommendation on Molson Coors to a hold. The analyst says the beer giant didn't hold on to share gains from last year's Bud boycott, especially considering that shelf space for Molson Coors beverages increased by 13%. They should have taken advantage of that and failed to. Finally, B. Riley is downgrading TripAdvisor to a neutral. The online travel site missing second quarter revenue estimates. The analyst says the disappointing report reflects deterioration in the company's core business. Sonali?
One stock to watch at the open is Disney. The company posted its first ever profit in the streaming department, but it's offsetting sluggish performance at its theme parks, which are seeing moderation in demand. You're seeing Disney shares down almost 3%, and CFO Hugh Johnson spoke earlier on Bloomberg Surveillance.
The lower income consumers are a little bit stressed and shaving a little bit off of their time at the park. And then higher income consumers are tending to travel overseas a little bit more right now. So we really just see this as a few quarters of slight perturbation in the numbers. Frankly, I think we're going to be right back as we get into the middle of next year.
Madison and Wall principal Brian Weiser joins us. You see the entertainment numbers out there. That's really what's spooking the market a little bit this morning. When it comes to Disney, you have the CFO saying that it's, let's say, somewhat of an aberration, not something more consistent. Bloomberg Intelligence, though, disagrees. Brian, how do you see these numbers playing out?
Yeah. Well, I thought the advertising numbers were certainly very strong, although they had also very, very easy comparables from the year-ago period. So it's kind of hard to read that. You may have seen Tegna also just came out with numbers which were probably closer to where the underlying TV business is at -5. And if you think about that, Disney did quite well, all things considered. When we look at the streaming business, they're continuing to grow and make good progress there. I think that the shift to including ad-supported offerings for Disney Plus, obviously really positive. Hulu's doing well. Consumers are willing to spend money on these services. And so I think that's probably, that's the stuff that I'm focusing on. It's a strong business in the long term because they are investing in content. They could be investing more. I think Disney Plus would probably benefit from more of that. But ESPN also is doing quite well, remarkable numbers from the quarter.
I wonder about the parks business, just because we've seen some eye-popping numbers recently, Brian, in terms of costs. I think I saw a report that a high-end trip with a family of 4 costs $40,000 to Disney World. Are they regretting their price increases, or are they going to hold tight, you know, since at least they're not seeing a decline, right? They're still seeing 2% gains year over year.
Yeah, well, I mean, I don't spend too much time thinking about the travel business, but I think that maybe I could point this out, that consumers are still spending an awful lot of money on services broadly. When I looked at the latest services quarterly survey from the Census Bureau, I mean, it looks like we're going to still see mid to high single-digit growth rates in spending on services. And exactly as Hugh Johnson pointed out, the higher-end consumer is probably driving that. The lower-end consumer is probably not. Now, can Disney parks, see some short-term challenges because there's going to be more spending on travel abroad? It makes sense to me. But the underlying spending patterns in terms of higher spending growth skewed towards higher-income consumers, I think, is probably going to help them in the long run.
You know, you think about Disney and the position it's been in the last couple of years, and in this earnings report, they really do tout pretty high up what they're seeing out of ESPN, ESPN Plus, and of course, there are some interesting deals happening in that industry ahead. Do you think that there's still a rationale, Brian, to bring up that conversation about what it would look like if ESPN was spun out of Disney?
Hey, and Brian, by the way, is a former investment banker, so like you're pitching these kind of deals, right, Brian?
Well, once upon a time, it does make a ton of sense because the dynamics of sports and sports-related video programming are so different than the rest of the industry. It made a lot of sense in a world where you could tie together access to the distributor to the sports-related product if you wanted the other product. Rather, you want sports, you're going to get all this other stuff you don't want. In this world that's more a la carte, it's a lot harder to tie those things together. Because the cost profile of sports-related programming is just so significant that you will not be able to avoid spending 8% more per year on the underlying sports rights. Whereas with the rest of the content business, those costs can probably go down. I mean, we talk about what an AI-driven content world starts to look like, especially when you look at reality TV and a lot of other programming, not news, not business news, certainly. The profiles of these businesses will look very, very different. So I do think that there is still a significant rationale for ESPN to eventually be spun out.
All right, Brian, great to get your take. Brian Wieser, not only famous for the analysis that he's done in media, but also for his investment banking experience. Great to get some experience and wisdom from you on this earnings report. Coming up, we're going to talk more tech, but less media. Tech-heavy hedge funds lost hundreds of millions of dollars in the recent sell-off. We'll discuss the ones that were hit the hardest next in our Wall Street Beat with Hema Parmar. This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Get your your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Time now for the Wall Street Beat. After the global sell-off took place earlier this week, some of the world's biggest hedge funds lost hundreds of millions of dollars as a result of being in the most popular of tech stocks. But the market turmoil helped Brevin Howard's flagship hedge fund swing to a profit for the first part of the year here. Joining us now is Bloomberg hedge fund reporter Hema Parmar, who's had her eyes all over the industry, and it's been a very volatile year. When you look at Brevin in particular, I think it's an interesting moment for macro funds to be capitalizing on things. They had lost some money earlier this year due to wrong way bets on Fed cuts. How did the turmoil help?
Yeah, so you're actually seeing an example of a fund doing well in this market. They were down before July. Now they're up about 1%. They made about a 2% gain in the past couple days, which is, really good for them. They have been saying since January that the market isn't pricing in enough rate cuts to come, and so they are expecting more to come. And it looks like their bets have helped them.
What's going on at Light Street?
Yeah, so this is a fund that is not winning, down 9% in 1 month of July alone. They may be down more when you look at the turmoil in August. Up 40% for the year, but keep in mind this is a fund that has big bets.
40% for the year, including the bad month.
Including the bad month.
Yeah.
This
That's what I was going to say. They did really well before this.
They did, but they're still digging themselves out of 2 years of losses. In 21 and 22, they were down a collective 40%. So, they're trying to dig themselves out of this high water mark. Their biggest position, NVIDIA, about 17% of their portfolio as of March. Sizable chunks in these tech stocks, and that can work for you and the market's great, but when you see a really difficult month, it can really backfire.
How about some of these Tiger Cubs? It's interesting to see what's happening at Tiger Co2. They had similar problems, to my understanding, as Light Street. How does this year complicate getting out of that kind of high watermark moment that they're grappling with?
Yes, a lot of funds had a very difficult couple years and need to try to get out of that hole. And so, every month matters. Every month that you're not making money impacts the year-to-date return, impacts what investors expect, and will impact whether or not they continue to stay in the fund or they give it more time. So, until investors are made whole, the firm is also not charging fees to the full extent. And so that impacts how much they're bringing in terms of expenses and revenue.
Joe, pull up that full screen again of their holdings, because I think it's interesting to look at the fact that they're green check marks on almost every single one of these stocks for almost every single one of these hedge funds.
Yes.
I mean, it's a herd.
Concentration risk you're worried about too.
Exactly.
Precisely. So, these funds, generally Tiger Cubs, even some that are not, these are their top 10 positions. Their biggest stakes are in these companies: Meta, Amazon, Microsoft, NVIDIA. So it's unsurprising that when you see a very difficult month in tech, that you see this pain kind of across the board to different extents.
But why pay 2 and 20 for that? Why don't you just buy the cues?
There were some funds up. David Einhorn was up. Rentec was up. So let's not throw all the babies out with the bathwater, Matt.
And they're less tech focused too. So they're more healthcare and other things too.
All right, it's interesting because, if you just own the S&P or the Qs over the past 10 or 15 years, you're outperforming any of those hedge funds. So, Hema, great to have you on to talk about the horse race. We've got to do this more often because I think it's pretty fascinating stuff. Hema Parmar covers hedge funds for us on the print side. In terms of what we're seeing in the markets, still green arrows across the board and getting better here. The S&P 500 up 1.4%, the NASDAQ up 1 2/3% almost. We've seen the Russell sort of hovering around that 1 1/3% gain. Coming up in the next hour, MicroStrategy Executive Chairman and Co-founder Michael Saylor is going to join us. I will tell you, he likes Bitcoin.
Yeah, he does.
I'm going to say he's going to go long Bitcoin. 10:30 a.m. Join us for that interview. This is Bloomberg.
just looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Equity markets bouncing back here. The S&P 500 up 1.7%. Alex Steele, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. Coming up, we're going to check in with Gina Martin-Adams. She is the equity strategist for Bloomberg Intelligence. I don't know. I mean, the markets are rebounding here. Was that just Monday, just a flash in the pan? I don't know. We'll speak to Gina about that. Disney reported numbers. They made some money on streaming. That's good news. But they kind of warned that the consumers kind of weakening a little bit, and that's going to impact their parks business. So the stock's down a little bit. We'll get the latest from Geetha Ranganathan. She covers all the media names for Bloomberg Intelligence. So a lot of market stuff, a lot of company stuff coming up in the next couple of hours. Let's kick it all off with a Bloomberg Business Flash with Lucy Mateo.
You got it. In stocks extending their gains after a Bank of Japan official pledge to not hike interest rates when the markets are unstable. So that changed sentiment a bit. Now we have the NASDAQ up more than 2%, 330 points at 16,697. We have the S&P 500 up more than 1.5%, 88 points, 5,329. And the Dow up more than 1%, 461 points at 39,458. We head over to the two-year yield, 4.00%. That's up 2 basis points. And then the yield on the 10-year, 3.94%. And that's up 4 basis points. Also, we mentioned Bank of Japan, so let's take a look at the Nikkei, up more than 1%. We go to currencies. You have the Japanese yen down more than 1.5% at 147.05 against the dollar. More economic data out today. U.S. 30-year mortgage rates plunged last week by the most in 2 years, 6.55%. Still not up to your 6%, Paul Sweeney, but it's getting there.
Coming. It's coming.
Reaching the lowest level since May of 2023 also sparked a surge in applications for refis. More data on the way today, including a report on consumer credit comes out later this afternoon. And finally, moving the markets, that would be Airbnb down 15%. The company issued that another disappointing outlook, also warned slowing demand, U.S. consumers. That is your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa Mateo. Market Drivers is brought to you by Interactive Brokers Portfolio Analyst. Consolidate and analyze all your financial accounts on one powerful dashboard for free. Sign up for Portfolio Analyst at ibkr.com/free PA. Happy Wednesday, everybody. Happy Hump Day. I'm Alex Steele alongside Paul Sweeney. I mean, I don't know. I'm still skeptical about this rally, but now I feel like I'm on my own.
Exactly.
I feel so
it's
lonely.
been in a second day. I mean, you see, think about Monday's trading. It was just blowout in the morning, really panic in the marketplace, and then it stabilized kind of midday, and we traded down. It wasn't going to be 4 or 5%, decline in the market. It kind of was 2.5%, 3%, and then yesterday, strong day, up 1%. Today, another strong day. So we'll see how it plays out. But
yeah, and we'll talk to Gina because she was saying yesterday too that as long as you stay above the 200-day moving average for the S&P, you're still in an uptrend. Some stocks, though, are definitely not in an uptrend, like Airbnb. Billy Lipschultz joins us. He is senior equities reporter for Bloomberg News. I gotta say, the numbers weren't that bad.
The second quarter numbers weren't that bad, but the guidance for third quarter was weaker than expected. They also, one of the things that really stood out to me is basically the company is trying to diversify its offerings. So if you go on the app, there are offerings for like a trip curated essentially by like Chris Rock, or when they were trying to lead into experiences, you could use Airbnb to book like a photo session or a painting class, or have someone give you a massage in the house. And the thing that stood out to me when I was looking up some of the reactions from the sell side is RBC saying that ramping up marketing spend at a moment when demand is softening tends to be the ultimate backbreaker for an internet stock in their experience. Which, good point. When you think about it, that does make sense. And when you're looking at a stock, again, we can call it a record intraday drop. It went public in late 2020. Now you're back at the lowest level since 2023. You're kind of dealing with these macroeconomic headwinds, slowing demand in terms of people booking in advance here in the U.S. as much as you want to pound the table on LATAM and Asia. There are a lot of questions, and investors obviously don't like questions. And when you're trying to tease out what the path forward for a company looks like with an uncertain macroeconomic backdrop, that's really one of the things that stands out to me.
yeah, stock setting a 52-week low here today, off about 15% today. But it is such a great model when you think about it. I mean, I never would have thunk about it. I don't use it per se, but I can see how it's a great model for so many people.
Well, the thing that's interesting is when you look at where they're driving the growth, it's people that are parties of 5 or more. So if we're all going on
ads
vacation,
on TV, which are very effective,
it makes sense.
Yeah, it's like you don't want the kids to be in your room because you still want to go do something. Put them up in their bedroom. And
also, if you travel with families, it's an easy way. The kids can just hang out while you guys hang out. All right, let's go to Rivian. What happened with Rivian?
Under pressure again. They maintain their guidance for the full year in terms of the number of vehicles they're going to make, but they're still losing a lot of money. Bloomberg likes to break it down on loss per vehicle sold, still north of $30,000 per car. Company really
they're losing $30,000 per car?
Yeah.
That's not sustainable.
Not sustainable, exactly. When you look at the reaction from management, it's like, all right, we're focusing on profitability. We need to get to a free cash flow positive business model and trying to actually churn up demand. I know we've talked about it for months at this point. It feels like, I don't know that many people who are out now at this point in time wanting to buy an EV, especially given the costs and also wanting to go after
I just think back to the research of our good friend Kevin Tynan, formerly at Bloomberg Intelligence. Now he's moved on to another shop, but he was saying this is a fixed cost business, kids. You need the only way to get profitable is to make more units. And so you can't. It's a fixed cost business. So bending metal is tough, he always used to say. That's where the metal meets the road, I guess.
Well, also, if we're talking about you need a cheaper EV to draw in more customers, that's not going to help your margin per car. And wrapping up, Supermicro
at one point, the best performer in the S&P 500, still up a lot if you bought a few years ago.
Now, this is an AI chip stock, right?
AI chip name. They help make some of those servers. But when you look at, when we saw the initial aftermarket trading, it popped double digits, seemed to beat across the board. But then when you kind of looked under the surface, margins were slowing, closer to 11% versus 17% year over year. And when we kind of have been seeing investors whacking some of these high-flying names, these AI names, if you're not beating across the board and you're not talking up demand and an ability to keep kind of cooking what you've been doing, you're seeing a market amount of selling. And when you look at the stock, it's down really sharply from those peaks. Still, again,
55% off that peak.
And that's a big
from just February.
And this is a company that, again, leapt past the mid-cap index, went straight from the small-cap benchmark into the S&P 500. Still a $30 billion market cap, but when you're down 15%, you're seeing kind of maybe some of the cracks showing. Again, we're going to be keeping a very close eye when we get those results from NVIDIA, but AI narrative playing out.
It's you knew it was coming. You knew that there was. I guess we all believe in AI as a thing, but the trading, you could say, is certainly speculative, and at some point it was going to pop, and maybe it's, I guess, down 55%. Looks like a pop to me. I don't know.
Well, that's why JP Morgan had their morning note out, which I thought was a great way of phrasing it. That basically what we saw was just the sell-off we were expecting to see, but it was disguised as a growth scare. And that, to your point, if you've had that kind of pop, you're going to have a sell-off. It just happened to be disguised as something else. Anyway, Bailey, thanks. I really appreciate it, Bailey Lipschultz.
I have to call out Bailey. He's got the Finance Bro vest on today. For
He
those,
does
for
have a
those,
finance
It dropped to the 70s, so I had to, bring it out of the closet.
Finance Bro.
Is that what happens?
Yeah.
You get the...
Yeah.
What's it? What, is it a zippy vest? Is it like a fleece zippy vest?
So we're across the street from Cantor Fitzgerald, and Cantor Fitzgerald, I think, is populated by guys that look just like Bailey Lipschultz, and they're all the same deli as mine. And to a person, they all have the Finance Bro vest.
Amazing.
Yeah.
How many do you have in your closet?
I got plenty, but I'm not a vest person, so I don't take them or I give them away. So
Oh,
I'm not
fair
a
enough.
vest person.
Fair enough. Yeah, I'm definitely also not a vest person.
I don't. If it's cold enough to wear a vest, why wouldn't I want my arms
Sleeves.
to be?
I agree with you.
I don't get
Bailey,
the whole
can you
vest
help us
thing.
with that?
It's all about the core temperature. I also like pockets. There's extra pocket space. I don't know what I put in them other than my hands when I stand at my standing desk.
I mean,
but-
zippies also, or in hoodies have that. Anyway, it's fine.
Hoodies
We still appreciate you. We just like to point out the Finance Bro. Good call, Paul Sweeney.
Very good.
All right, Bailey, thanks a lot. Really appreciate it. Bailey Lipschultz joining us from Bloomberg News with his Finance Bro shirt. All right, let's get to Gina Martin-Adams of Bloomberg Intelligence, Chief Equity Strategist. Gina, how much complacency at this point is still left in the market?
Oh, I don't think there's too much complacency at all, Alex. It's pretty rare to see the VIX spike well north of 60, as we did on Monday morning, and not have a full washout in sentiment. And I think we did see that by the time we got to the point of Monday close. The VIX was above 30. The 14-day RSI momentum score for the S&P 500 was just at 30. That kind of oversold momentum and extreme pop in VIX has historically led to positive returns 80% of the time over the next 3 months. So we've generally sort of washed out a lot of the complacency. I do think that to the degree that valuations are still a little bit too elevated in tech, that may be a space where complacency still exists. And, frankly, as much as we nitpick at these company earnings, the earnings have been very, very strong. So there's not a lot in the earnings that you can say really sort of dismantle the confidence in the tech space. If there's any complacency, it might be there, but I'd say markets at large have gone a long way to pricing out any sort of elevated enthusiasm.
So I'm still trying to figure out what happened. Like, what happened Monday, Tuesday, and today?
Sure.
Was it technical
You
stuff?
forget Friday.
Friday, too.
That
Well, I
happened.
wonder why I forgot Friday.
Let's get on the beach.
Because I'm on the beach. So is it a technical thing? Japan carry trade thing that people are telling me about? The Nikkei trading crazy? What was it?
I think it's predominantly about Japan, and you can almost one-for-one mark all the way back to the middle of July when the market started weakening as the yen turned made a significant turn in direction, right? So it's very much about an unwind of the carry trade. And then last week, when we did get final confirmation from the Bank of Japan that they were raising interest rates for the first time in 17 years, that created a lot of instability. That was then exacerbated on Friday with some relatively weak economic data in the U.S. So it's that spread in interest rate differentials between the U.S. and Japan that is really key to this market meltdown. That clearly widened substantially over the weekend. U.S. bond market starting to price for Fed ease, where the Japanese market is now starting to expect a tightening, and Japan created tremendous weakness in the currency markets, which then exacerbated declines in the equity markets. I mean, I think that there is a link between all of these markets that is very, very notable. When you have this carry trade in place for nearly 2 decades and it's starting to unwind, it creates some issues of forced selling, some liquidity issues broadly that generally impact the equity markets. And I think that's largely what's driven the instability. Thankfully, overnight, we did get some news from the Bank of Japan that they've committed at the very least not to tighten during periods of general financial market distress going forward. But, frankly, we are in a different path for central bank policy than we have been in points in the past. So we're going to have to be on guard for bouts of indigestion as we adjust to this new normal.
All right, Gina, I've been doing the stock market thing for 35 years. I have no idea what's going on out there. Gina Martin-Adams, she's a pro.
That was not helpful.
Exactly. I have no idea what's going on. Gina Martin-Adams, Chief Equity Strategist for Bloomberg Intelligence, joining us there. Again, the S&P 500 continuing to rebound today, up 1.6%. Earnings do matter. We continue to focus on earnings. We had some earnings coming out of a big media company yesterday. The Walt Disney Company put out some, I guess, mixed numbers. They made some money in the streaming business. That's good. But I think they warned that the parks business, our consumers getting a little bit tired there, so we may see a little bit slower growth there, a little bit decline even. So let's break it all down. We could do that with Geetha Ranganathan. She covers all the media stocks for Bloomberg Intelligence. So Geetha, what was your first reaction when you saw the Disney numbers? Because the stock is trading off a little bit today.
Yeah, thanks, Paul. So, as expected, there was weakness in the parks segment, but I think what kind of spooking investors today is not just the magnitude. So they had expected kind of flattish profits for the quarter that they just reported. They actually reported a 3% profit decline. But I think what is more disconcerting is that they expect to see kind of this lingering weakness in the park segment. So they're saying a mid-single-digit operating income decline again in the next quarter, and they expect the softness to last out a few more quarters. So obviously the consumer is not going to come back in a big way for at least another 3-4 quarters, and I think that is definitely creating some nervousness.
Did I tell you I canceled my Disney trip?
Whoa, there
I did.
There
I was
goes.
like, you know what? I don't want to spend $6,000 on this.
Really?
And I wasn't even like going anywhere fancy. I was just like, this is ridiculous for 4 days.
No kidding.
Yeah.
Did you tell your daughter this?
I didn't tell her we were going to begin with.
Oh, good.
So I really saved myself on that one.
Yes.
But Geetha, we know that the consumer is slowing, right? We got that from Comcast, for example, and their parks. But they made a profit in streaming. I mean, come on. Isn't that what we really care about?
That is, which is why, I mean, I think the stock is not reacting as badly as maybe it would have. So streaming has obviously been, a big, or rather streaming profitability has been a big focus. They have turned the corner, and it's obviously going to continue to be a big earnings growth driver. Remember, just yesterday, they actually raised prices, or they're planning to raise prices across all of their streaming tiers, including as much as a 25% hike on their ad-supported tier. So, this is going to become a significant earnings growth driver going forward. And then one of the things that we've really been complaining about with Disney, and I think investors have also been a little bit worried about, has been kind of their content engine. But they are back, and they're really kind of back with a bang. So, obviously they had the huge success of Inside Out 2 in the quarter that they just reported. And then now you have Marvel's Deadpool and Wolverine, which I think is your favorite, Alex. And that's
it is.
So, Geetha, going back to Alex's point, I mean, if somebody like an Alex Steele cancels a Disney theme park trip concerned about price, is there a fundamental concern that Disney's just kind of outpriced themselves out of the market, that they're starting to hurt demand?
Yeah, that definitely is a huge concern right now, Paul. And so I think what we're going to see is they obviously are not going to be able to raise prices. We were seeing something like a 40% increase in per capita spending, across the parks for many quarters. But I think what they kind of did was they over forecasted demand, and I think and under forecasted the reversal from that pent up pandemic demand. And so that is what we really are going to see play out over the next few quarters. Having said that, though, I mean, yes, the domestic park business is going to see some softness, but they do have the cruise business, which obviously is going to take off in a big way. They have 3 new ships that are coming on board over, the next few quarters. So they are expecting some of that softness in the domestic parks to kind of get offset. But again, it's going to be kind of a wait and see.
All right.
Disney
Geetha.
cruise. I don't want to do that.
See, I think we can book you on a Disney cruise.
Yeah?
I've been on the cruise ships. I'm not a cruise person, but they're awesome.
But am I going to have like Mickey Mouse talking to me and stuff?
Maybe.
Yeah, I don't want that.
Maybe.
Yeah,
You might have that. All right, Geetha, thank you so much for joining us. Geetha Ranganathan, media analyst for Bloomberg Intelligence. Oh, my goodness, calling in from somewhere really far, Chennai, India, where she's from.
Oh.
How good is that?
Thanks, Geetha, for doing that. That was nice. We appreciate that.
Excellent. Yeah, she's from Chennai. She speaks like 27 different languages. She learned Japanese just for fun. And she learned it so well that she worked on the Japan desk at Bloomberg Global Data to talk to clients in Japanese.
I barely speak English.
Exactly.
That's amazing. All right, coming up, we're going to talk about energy storage. Stay with me, Paul. It is fun. It is cool. We're going to talk to the CEO of Energy Vault. He'll be joining us right after this break on company earnings.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Stocks continue their upward momentum. We have NASDAQ up more than 1.5%, 250 points at 16,621. We have the S&P 500 up more than 1%, 71 points, 5,311. The Dow up 0.9%, 383 points, 39,381. So where the biggest spike is coming from? Let's check the IMAP feature on your terminal to find out. Of the 11 major industry groups, the biggest push that's coming from information technology. And you dig deeper, you go and you see software and services, then software, then system software, and all the way at the top you have Microsoft. Microsoft shares up more than 2%. And right below that, that was followed by cybersecurity company Fortinet. That actually forecasts adjusted earnings per share that beat estimate. Their shares up about 0.2%. We'll head over to the bond market. The 2-year yield at 4.02%. That's up 4 basis points. The yield on the 10-year 3.94%, and that's up about 4 basis points. I have to point out Bitcoin down right now. Well, a little change at 56,547. And to earnings we go. We'll end off with Lyft. Lyft shares down 13%. Bookings and outlook just missed estimates. That is your Bloomberg Business Flash. Paul and Alex.
All right. Thanks so much, Lisa Mateo, joining us. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business and finance and economics through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries worldwide. I gotta say, we're off the highs. I'm just saying.
Yes, true. Yeah, I see that.
Bring my skeptic
in the trading range here, but still combined with yesterday, it's a nice turnaround.
I know. I have to wonder though, if we're in a more volatile regime in general.
Yep.
Does that change your calculus? Does it change how much risk you have to have on? Does it change when you buy risk? All that kind of stuff. Anyway.
Yeah. We'll see.
These are my thought processes here. Okay, let's go to the other thing that I love, and that's energy. How to store energy is huge. And it's huge because if you want to diversify what energy you're using, like wind and solar, and even hydrogen, you need batteries, and you need really big batteries to be able to store it. Now, you can maybe do it for a couple hours, maybe a day or two, but doing that longer is proven really difficult and really expensive. And one company is trying to change that. The company is called Energy Vault. Now, it's SPAC'd back in 2021. Before it's SPAC'd, SoftBank was an investor. It's a Swiss startup, basically, that is trying to find different ways of storing energy. And the CEO joins us now, Rob Piccone, CEO of Energy Vault. He joins us from Switzerland. Rob, we appreciate the time. Can you just describe a little bit, in dumbed-down language, what it is that you guys do?
Sure. So we broadly focus on energy storage, and we focus on it with varying technologies and software. So we do shorter duration energy storage using lithium ion. We do long duration energy storage, meaning things that get sort of in a 6, 8, 12, even 24 hours. So full day types of storage with a unique gravity solution where we lift and lower blocks, or we'll shift water from different heights. And we also do ultra long duration, meaning multi-day storage using green hydrogen and microgrids.
Who are your customers, Rob?
Our main customers are first and foremost utilities, so we can sell directly to utilities, and we also sell to independent power producers, so the ones that will, for example, build out solar or wind and pair storage with that and have long-term contracts with utilities. And the third group are the large industrial users. So our investors include people like Saudi Aramco, BHP, the largest mining group in the world, and groups that are looking to make their own clean energy transition, or that have desires to make green hydrogen, for example, where you can make that using solar, an electrolyzer, but you need long duration storage. So because our technologies focus across a series of durations, we can actually meet a lot of those needs, and hence serving those 3 market segments.
So let's go back to the gravity storage solution thing. So this is from an article here at Bloomberg from a few years ago, but it describes it, and I feel like accurately and pretty well. An electric crane hoists up blocks of concrete and stacks them into a tower when power is plentiful. When power is needed, it uses gravity to take the structure apart brick by brick, and the weight of the descending blocks converts kinetic energy into electricity. That sounds really hard and complicated.
You know what? Gravity's been around for a while. I tell people it's not an idea, it's a law. So the whole physics of moving weights up and down has been around. But you're right, to do that in a way that's economical, to do that now with software where we can automate that entire process and dynamically look at the timing and dynamically accelerate that lifting and lowering. And also, we actually don't use concrete, so we avoid it because it's not really sustainable. It's one of the contributors, I think, 7 to 8% to greenhouse gases. So we actually have a material science team and worked with Cemex to use dirt and even waste materials like coal ash, even concrete debris, other things that would go into landfills. We can utilize that to make these large blocks that are 25 metric tons. So we try and avoid materials that are not sustainable to make those very same blocks.
So how is, I guess, your business changing to try to meet the changing sources and uses of energy these days?
It's a great question, and it is one of the challenges. It's definitely focused globally on countries wanting to achieve energy independence, and to do that, you need to be able to produce locally. Hence, our gravity solution that's more long duration, of course, is ideal because you can produce most of that from local materials, local labor. I mean, it's construction, you're building a building. When you get to the short duration, which is most of the market today, and we know about lithium ion, so that's 2 to 4 hours, that's this time shifting people trying to manage. You're relying on the rare earth metals, which I believe, Paul, what you're referring to. And that's where, through mechanisms like the IRA that was put in place in the US, they're trying to get that localized. And to deal with that, you have to come up with mechanisms to try to bring some of that production local as much as you can in terms of getting content. And that's been a big focus area, and of leveraging technologies like hydrogen, for example. Green hydrogen can be made sustainably. We're using that to back up the city of Calistoga in Northern California near Napa to provide a sustainable backup solution for 2 to 4 days that otherwise would have taken natural gas. So it's a combination of technologies you really have to use to solve this issue of reliance on either a few countries in the world or a few rare earth metals.
So if I just look at your stock, it's 93 cents. It's had a tough road since it's SPAC, right? I mean, clearly there was a lot of enthusiasm in the beginning. You had a nice pop, and then it's been really tough. In the last earnings estimate, and the last earnings for second quarter, the headline is revenue missing estimates. How do you manage this at this time? It's expensive to probably get all this done, even though the demand we know is still there.
Yeah, the demand is high, and the capital markets have been very challenging. In particular, if you go back to mid-2022, when the interest rate environment changed, and really fundamentally, I think the risk appetite for new emerging growth companies like ours really soured and changed. And for us, we focused on execution, and we had 148 million in our first year of revenue, 2022. Our second year, almost 350 million, so we more than doubled the size of the company. But at the end, investors are really focused on cash flow and minimizing risk. We've guided that that's going to happen next year. So in our first, I guess would be our third full year of revenue, that we're going to be cash flow positive and EBITDA positive. And I think until that happens, a lot of investors are on the sidelines. And what we can do is what we're doing, which is executing for customers and in different regions of the world. We announced new deals in Australia. We announced a large gravity project in Italy at a coal mine. And I think filling up that order book, Alex, is going to be fundamental. So investors see it's not about if, it's just about when. And as we fill that order book, then when that cash flow roadmap becomes very clear, which we're getting there to 2025, which is what we guided, I think then we'll see investors re-entering the stock.
In the interim, how do you fund your growth? Because I'm looking at the FA function, which gathers up all the analyst estimates. Still no positive free cash flow in sight here. So how do you fund that growth?
Well, we're in a great cash position. So we're well north of 100 million, no debt. Unlike a lot of the companies that pursued the SPAC route, they've done dilutive convertible notes and really at high cost, and also that hurt investors. We've done none of that. So we have no debt as a company, well over 100 million in cash, and we've reduced our burn rate to about 15 million a quarter. And in the meantime, we're ramping up now that revenue. We've guided 500 to 700 million between this year and next year. We do have a second half ramp, so that's not unusual when we're relying on EPC projects and the timing of these project starts. So that's from a cash perspective and being good stewards of the shareholder money and cash, we've actually done a very good job of that. And that's going to be playing out as we get into our growth period where we don't have a need to take on debt.
All right, Rob, we really appreciate it. Thank you so much. It's such an important space, and particularly with all the money flowing into it from private equity, companies, as well as governments, we appreciate that insight. Rob Bocconi, CEO of Energy Vault, joining us on energy storage, which we definitely need. I think the question also becomes, we just had SunPower file for bankruptcy yesterday. It's a solar company based in California, and there were idiosyncratic issues to be sure. But what happens when someone else or whoever takes the White House in November? If it's President Trump, what areas of this gets rolled back?
Right.
Of the IRA? Maybe nothing. I mean, money's already been spent, but maybe something. And I think that must be very difficult to kind of manage in this business right now.
Right. And if you're an investor, do you want to stick around and while you have that level of uncertainty? You know? So yeah, we'll have to see. So certainly one of the industries that is paying close attention to the national elections. The markets continue to trade pretty solidly here. They've got the S&P up 1.3%. The NASDAQ up 1.6%. So nice rebound off of that trading from Monday. With our news in New York City, here's Mr. John Tucker.
All right, Paul. Tropical storm Debbie swirling over coastal Georgia and Carolinas. Wide bands of rain swelling inland waterways before slowly marching north. The meandering storm has already drenched coastal cities in Georgia, South Carolina with more than a foot of rain. Forecasters warn 5 inches of rain could fall from South Carolina to Vermont through this weekend. Vice President Harris stepping up her efforts to bring rank-and-file union members in swing states back to the Democratic fold, this time with Minnesota Governor Tim Walz in tow as her running mate. He's gained attention for deriding Donald Trump, his running mate Senator J.D. Vance of Ohio, and the policies they espouse as weird. We asked Tina Fordham, founder and geopolitical strategist at Fordham Global Insight, about that kind of messaging.
Speaking from a political science point of view, it can be a very effective tool for marginalizing your opponent. There are those who would say that using humor or satire is childish. I don't agree. And also, it works a lot better than Biden's apocalyptic rhetoric, which really didn't move people.
The new Democratic ticket will hold rallies in Wisconsin and Michigan today, with United Auto Workers President Shawn Fain expected to join them. Cori Bush lost a bitter primary battle, further shrinking the squad of House progressives. The Missouri Democrat is an outspoken critic of Israel's handling of the war in Gaza. And the fashion house Dolce & Gabbana launching a new perfume for dogs called Fifi in honor of Dolce's poodle, Domenico. But not all vets and pet owners agree it's safe or even appropriate. The perfume costing $108 for 3.4 ounces. It's been certified suitable for animals, but vets say they may interfere with the animal's important sense of smell. Global news 24 hours a day, wherever you want it with Bloomberg News Now.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got green on the screen. The NASDAQ leading the gains up more than, well, just about 1.5%. 240 points, 16,608. The S&P 500 up more than 1%, 65 points, 5,305. The Dow up 0.9%, 356 points at 39,352. The two-year yield at 4.01%. That's up 3 basis points. And the yield on the 10-year, 3.93%. And that's up 3 basis points. Stocks in Japan up more than 1%. This was after a Bank of Japan official pledged not to hike interest rates with the markets when they are unstable. Now, its rate hike last week caused major moves in the yen and record-breaking swings in Japanese stocks. Speaking of the yen, down more than 1.5% at 146.75 against a dollar. Shares of EV startup Rivian down 2% right now. Second quarter revenue missed estimates. Cash burn for the period was bigger than expected too. And then shares of computer hardware maker Super Microcomputer down 17%, and this is after reporting quarterly revenue and profit that missed estimates. That is your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa Mateo. I'm Alex Steele, Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to you live from our rainy Interactive Broker Studio right here in New York, although I don't know if it's actually raining right now, but it doesn't look pretty.
It's dark.
It looks dark. It looks a little grim, looks a little dark. All right, let's go to the bond market for a moment, because 4 years ago, those 20-year bond auctions were a thing of the past. But Treasury Secretary at the time, Steve Mnuchin, reintroduced those 20-year bonds in monthly auctions. Their sale, apparently, if you just do back-of-the-envelope calculations, tacked on